Hello and welcome. Today we are diving into a topic that, let's be honest, affects every single one of us, taxes. But this isn't going to be about just paying them. No, this is about mastering them. We're going to lay out a complete roadmap to take you from that tax season confusion to a place of total financial confidence. You know that feeling when tax season rolls around? For so many of us, it feels less like a simple task and more like we've been dropped into a complicated maze in the dark. It can be stressful, confusing, and frankly, a bit intimidating. But what if you had a Mac?
So, do any of these sound familiar? That feeling that you're losing your hard-earned money? Or maybe you stare at your salary slip and it just looks like a bunch of confusing numbers. What about that nagging worry in the back of your mind? Did I make a mistake while filing? If you've felt any of this, you are in exactly the right place. We're about to turn these worries into strengths.
All right, so let's get started. Think about it like this. You can't build a tall building on a shaky foundation, right? Well, it's the exact same thing with smart tax planning. You need a solid base to build your savings strategy on. So, our first step is mastering the absolute basics. First things first, we've got to demystify the jargon. You hear these terms thrown around all the time. Financial year, assessment year, knowing the difference is absolutely crucial. It's really just the basic timeline of when you earn your money versus when that money gets taxed. We're going to make that crystal clear.
Next up is maybe one of the biggest mysteries for any employee. That gap between your CTC and your actual take-home pay. Where does all that money go? We'll break down that salary slip piece by piece so you know exactly where every single rupee is going. No more guesswork.
And here's something that a lot of people overlook. Your tax bill isn't just about what you earn, it's also about where you are. We'll explore how your residential status, whether you're a resident, an NRI, or an RNOR, can fundamentally change your entire tax plan. So, with that foundation set, we get to move on to the really exciting part, actively saving your money. This is where you learn how to use all the tools the tax code gives you to your maximum advantage. The first and honestly the most straightforward tool in your kit is the standard deduction. That's a flat 50,000 rupees off your taxable income. Boom, right away just for being a salaried employee. It's a direct benefit that's so easy to miss if you don't know to look for it. Now let's talk about the real powerhouse of tax savings, Section 80C. This one section alone can let you reduce your taxable income by up to 1.5 lakh rupees, and sometimes even more. But the key, the real secret, is knowing which investments to make. And this is where things get strategic. See, 80C isn't a one-size-fits-all solution. You've got options, from the safety of provident funds to the growth potential of things like ELSS. We'll guide you on how to choose the right mix that lines up with both your tax-saving needs and your bigger, long-term financial goals. But the savings absolutely do not stop at 8C. There is a whole universe of other deductions out there. We're going to cover everything from your rent allowance and health insurance premiums to the interest you pay on home and education loans. Each one is another key to unlocking more savings. Okay, now let's see how this all builds into some more advanced stuff. Once you've mastered those core deductions, it is time to start thinking like a pro and weaving tax planning into your entire financial life. It's so important to remember that not all tax-saving investments are created equal. We'll give you a framework to look at them based on what matters most to you. Are you chasing growth? Is protecting your capital the #1 priority? Or do you need to be able to access your money easily? Now this part is a real game changer. Your salary isn't just a number, it's a structure. We'll show you how you can actually work with your employer to optimize it, using things like perks and reimbursements to legally and effectively increase your in-hand pay. And for those who really want to get to that pro level, we'll go beyond your salary. We'll dive into strategies for generating tax-free income and how to manage capital gains from your investments, essentially turning your portfolio into a tax-efficient machine. And finally, we get to the finish line, the act of filing your returns. All the planning in the world means nothing if you can't confidently and correctly report it. So this final part of our journey is all about empowerment. The single biggest decision you'll have to make at filing time is choosing between the old and the new tax regimes. One gives you a ton of deductions, the other offers lower tax rates. We'll do a deep dive comparison with real-world examples so you can definitively choose the path that saves you the most money.
No more fear of forms. We'll teach you exactly how to read your Form 16, how to cross-check it with your Form 26AS and your AIS, and make sure everything matches up perfectly. This is the real key to avoiding those dreaded tax notices.
Finally, we put it all into practice. We'll walk you through the actual filing process for ITR1 and ITR2. Those are the key forms for salaried folks, and turn what was once a really daunting task into a simple, step-by-step process. So what's the end result of this whole journey? Well, it's a transformation. You'll go from being a passive taxpayer to an active planner, someone who knows how to legally maximize deductions, optimize investments, and file your returns with absolute confidence. No errors.
Because, at the end of the day, smart tax planning isn't just about saving money, it's about taking control of your financial future. So the real question is, are you ready to stop being confused by the system and start making the system work for you?
Hello, everyone, and a very warm welcome to our course, Smart Tax Planning for Salaried Employees in India. We're starting right at the beginning with our very first chapter, an introduction to income tax. Think of this as building a strong foundation. So let's get right into it.
Okay, let's be real for a second. Have you ever stared at your salary slip and felt like it's written in some kind of secret code? You see all these letters, HRA, LTA, PF, and then you see this big chunk of your hard-earned money just gone under a heading called income tax. If you've felt that, trust me, you are not alone. It can feel super confusing. But here's the best part. Getting a handle on all this isn't just about learning boring theory. It's actually the most powerful way to legally pay less tax and, you guessed it, keep more money in your own pocket. It's all about making your salary work smarter for you.
So, before we can even think about saving tax, we need to learn how to speak the language of tax. I promise it's way simpler than it sounds. It all boils down to two very important ideas that you'll hear all the time.
First up, the financial year, or what everyone just calls the FY. The easiest way to think about this is to compare it to a school year. It always starts on April 1st and ends on March 31st of the next year. This is the 12-month window where you're earning your salary, getting that interest from your bank FD. Basically, it's the year where all the money making happens.
All right, so if the financial year is the school year where you do all the work, then the assessment year, or AY, is when you get your report card. Simple as that. It's the year that comes right after the financial year, and it's the time when you actually sit down and file your taxes for the income you just earned. This timeline makes it super clear, doesn't it? Let's say you're earning your salary from April 2025 all the way to March 2026. Well, that's your financial year 2025-26. And the very next day, April 1st, 2026, marks the start of the assessment year 2026-27. That's your deadline period to file the return for the money you just made. Just remember this golden rule. You earn in the FY and you assess or file in the AY.
All right, now that we've got the basic language down, let's talk about what is probably the single most important choice you as a salaried person have to make every year. And that is, should you go with the old tax regime or the new tax regime?
Think of it like this. The new regime is now the default setting for everyone. It's clean, simple, has lower tax rates, and it's brilliant if you don't have a lot of things to claim, like you're not paying a big home loan EMI, or you don't have tons of investments. The old regime, on the other hand, is now optional. Its tax rates are higher, but it has a superpower. It lets you claim a long list of deductions for things like rent, insurance, and investments, which can seriously reduce your taxable income.
Let's just look at the numbers for the new regime. This is the default option, remember. Just notice how nicely the rates step up. Up to 4 lakhs, you pay nothing. From 4 to 8 lakhs, just 5%. It's a much gentler climb compared to what we had before. But here's the real magic number you need to remember for the new regime: 12 lakhs. Why? Well, because of something called a tax rebate. Basically, if your total taxable income in the year is up to 12 lakhs, this rebate kicks in and makes your final tax payable a big fat 0. Now, let's look at the old regime. See the difference? The tax-free limit is much lower at 2.5 lakhs, and the rates jump up really fast. The moment you cross 5 lakhs, you're already in the 20% bracket. And after 10 lakhs, you're in the 30% bracket. So just looking at it, it seems way more expensive. So why would anyone pick the old regime? Well, because of its superpower, remember? Deductions. In the old regime, you can subtract a whole bunch of your expenses from your income before the tax is even calculated. We're talking about things like your PF contribution, your life insurance, your kids' school fees, medical insurance, the rent you pay for your house, and of course, the interest on your home loan. If you have these expenses, the old regime can still come out on top. Okay, so we've been using this term slab rates. It might sound a little technical, but I promise you, the idea behind it is incredibly simple. Let's just quickly do a calculation together to see exactly how it works. Let's say your income is 15 lakhs for the year, and you're in the new regime. Now, the most important thing to get is that your entire 15 lakhs is not taxed at one single high rate. No way. It's broken into slices, or slabs. So as you can see, the first 4 lakhs, totally tax-free. The next 4 lakhs are taxed at a gentle 5%. The next 4 at 10%, and only that last little bit, the final 3 lakhs, gets taxed at 15%. You just add up the tax from each slice, and your total tax comes to 1,05,000 rupees. See? It's just simple step-by-step math. All right, I know that was quite a bit of information, but you're doing great. So how about we put that new knowledge to the test? Let's do a super quick quiz. Ready? Question number 1. You get a new job and start earning in June of 2025, and you work through to March 2026. Which financial year and which assessment year are we talking about here? Take a second to think. Got it? The answer is financial year 2025-26, because that's when you earned the money, between April 25 and March 26, and you'll file your taxes in the assessment year 2026-27. If you got that, fantastic. Okay, next one. Your total income for the year comes out to be 11.5 lakhs, and you've decided to stick with the new tax regime. How much tax do you actually have to pay? Think back to that magic number we just talked about. The answer is a very, very satisfying 0. That's right, nothing, nil. Because your income is under that 12 lakh magic threshold, that special tax rebate just completely wipes out your tax bill. It's a perfect example of just how powerful that new rule is for so many people. And with that, you have officially mastered the absolute fundamentals of income tax in India. Seriously, you now get the core ideas that everything else is built on. So well done. But hey, this is just the beginning of your journey. In our very next chapter, called Understanding Salary Structure, we are going to get really practical. We're going to grab a typical salary slip and decode every single part of it, HRA, LTA, and show you exactly where the hidden opportunities to save tax are hiding. So, I'm going to leave you with one final thought to ponder until we meet next time. Now that you know the basic rules of the game, the simple low-rate new regime versus the deduction-packed old regime, which one feels like it might be a better fit for your life right now? Just thinking about that question is your very first step towards some really smart tax planning. Thanks so much for joining me. Hey everyone, and welcome back to our course on smart tax planning. we're jumping right into Chapter 2 of our very first module, and this one's a biggie: understanding your salary structure. Look, if you've ever felt that confusion between your offer letter and what actually hits your bank, trust me, you are in the right place. Let's get into it.
It's that classic feeling, isn't it? You see this big, impressive CTC number, the cost to company, but the in-hand salary that gets credited every month, well, it feels a little smaller. So what's the story? Where does all that money actually disappear to? In this chapter, we're going to crack that code once and for all.
So, a very warm welcome to Chapter 2. In our first chapter, if you remember, we laid the groundwork. We talked about the basics of income tax and that super important choice between the old and new tax regimes. Now, we're rolling up our sleeves and getting practical. We are going to pull apart your salary, piece by piece, so you know exactly where every single rupee is headed. So here is our game plan for today. First, we'll simplify what salary even means. Then, we'll get into the nitty-gritty of your payslip. After that, we solve the big CTC versus take-home puzzle. And finally, we'll learn how to read your Form 16 like a pro. By the end of this, you'll be an expert on your own earnings. All right, let's kick things off with Section 1, your salary simplified. Before we get into all the complex stuff, we have to start with the basics, right? Building a strong foundation here is absolutely key to understanding everything else. Now, the very first thing you've got to understand is that your salary isn't just one single number. Think of it more like a structure built from three main parts. You've got your basic salary, then various allowances, and finally, something called perquisites. If you can get your head around these three, you've basically cracked the code to your entire payslip. Okay, so let's pop the hood, shall we? Let's take a closer look at those three building blocks. This is where we really get into the details and see how your earnings are actually put together. First up is your basic salary. The easiest way to think about this is that it's the foundation of your entire pay structure. It's the fixed core amount, usually somewhere between 30 to 50% of your total CTC. And this number is super important because a lot of other things, like your Provident Fund or PF and your house rent allowance or HRA, are actually calculated based on this one figure. Next up, we have allowances. These are basically fixed amounts your company gives you for specific needs, like your house rent allowance or HRA to help with rent. And here's the best part: some of these allowances can actually help you save a good amount of tax. But, and this is a big but, remember what we talked about in Chapter 1? These tax-saving benefits are mostly for those who stick with the old tax regime. In fact, the HRA benefit is one of the main reasons so many people still prefer the old system. So, how much of your HRA can you actually claim as tax-free? It sounds complicated, but I promise it's pretty simple. The Income Tax Department just gives you three conditions. You calculate all three, and whichever amount is the lowest, that's your tax-free HRA. Let's just walk through a quick example to make it really clear. Okay, meet Rohan. He lives in Bangalore. His basic salary is 25,000 rupees a month. His company gives him 12,000 in HRA, and his actual rent is 15,000. So let's do the math. Number one, the actual HRA he received is 12,000. Got it? Number two, since he lives in a metro city, and for tax purposes that's Delhi, Mumbai, Chennai, or Kolkata, plus Bangalore is considered one for this, we take 50% of his basic, which is 12,500. And number three, his rent paid minus 10% of his basic, that also comes out to 12,500. So we have 12,000, 12,500, and 12,500. The lowest of the three is 12,000. So for Rohan, his entire HRA of 12,000 rupees is completely tax-free. See? Not so bad. And the final piece of the puzzle is perquisites, or as we all call them, perks. These are those nice non-cash benefits your company might give you. You know, things like a company car, a club membership, maybe even some food coupons. They're great to have, but just remember, the tax department usually sees them as part of your income, so most of these perks are, in fact, taxable. All right,
Now that we know the building blocks, let's put it all together and finally solve that big mystery we started with, the massive difference between your CTC and your actual in-hand take-home pay. Here it is, plain and simple. Think of your CTC as the promise. It's the total cost your employer bears for having you on board for a year. It includes your salary, the contribution to your PF, maybe a bonus, gratuity, everything. Your take-home pay, on the other hand, is the reality. It's the actual cash that hits your bank account after all the necessary deductions are made. Things like income tax, your own PF contribution, professional tax, and so on. This chart makes it super clear. Let's say you have a 12 lakh CTC. You're not getting 1 lakh a month in your bank account. A big slice goes towards your income tax, or TDS. Another slice goes into your retirement savings, the Provident Fund. A smaller piece is set aside for things like gratuity. And that biggest slice remaining, that's what you actually take home. So the money doesn't just vanish, you see. It's just put into different buckets for you. Okay, we're almost there. One final but super important piece of the puzzle for this chapter is your Form 16. The best way to think of this document is as your official annual report card for taxes, straight from your employer. Seriously, when it's time to file your taxes, this document is everything. Your Form 16 is the official certificate that your employer gives you. It proves exactly how much you earned in the year and, crucially, how much tax they deducted and paid to the government on your behalf. It's the single most important piece of proof for your tax return. Now, your Form 16 is neatly divided into 2 sections. Think of Part A as the government's receipt. It shows a quarter-by-quarter summary of the tax that your company deposited in your name. Part B is more like your personal statement. It gives a detailed breakup of your salary, lists all the exemptions you claimed like HRA, and any other deductions you declared during the year. Put them together, and they tell your complete financial story for that year. And that's a wrap for this chapter. Let's just take a quick moment to look back at all the powerful new skills you've just picked up in today's session. Just think about it. You can now look at any salary slip and understand what's going on. You finally know the real difference between CTC and your take-home pay. You can spot all the key parts, like your basic, your HRA, your perks, and you know exactly what your Form 16 is for and how to use it. This is a huge step towards taking full control of your money. So, what's next? Well, now that you're an expert on your income, it's time to learn how to protect it. In our very next session, Chapter 3, we'll be starting Module 2 of our course. And we're going to dive deep into the really fun stuff, all the powerful deductions and exemptions, like Section 80C and 80D, that can legally slash your tax bill and put more money right back in your pocket. So, I'll leave you with this one question. You now know how to read and understand your payslip. The next logical step is to make it work for you, to make it truly tax smart. Are you ready for that? I really hope the answer is a big yes. I can't wait to see you in Chapter 3.
Welcome back, everyone, to our course on smart tax planning. So, in our last session, we got really hands-on and decoded your salary slip. Today, we're diving into something that sounds super technical, but trust me, it's one of the most important basics you need to know: your residential status. Figuring this out is literally the first step to understanding what you owe tax on in India. Okay, let's get right into it.
So, let's kick things off with a question I get all the time. You're an Indian citizen, you've got an Indian passport. Does that mean your entire income, no matter where in the world you earn it, is automatically taxed in India? What do you think?
Well, here's where things get interesting. For the income tax department, your passport doesn't really matter. The only thing they care about is a little concept called your residential status for that specific financial year. Look, it's pretty simple when you see it side by side. Your citizenship, that's based on your passport, where you were born. It's more or less permanent, right? But your residential status, that's all about one thing: counting the number of days you are physically present in India. And here's the kicker: it can actually change every single year. So, how do we figure this out? Easy. It's a simple step-by-step check. The very first question you have to ask yourself for any given year is this: am I a resident of India as per the tax rule?
Now, the law gives us two simple conditions, and you only need to meet one of them. The first one is super straightforward. Were you in India for 182 days or more in that financial year? If the answer is yes, that's it. You're a resident. Game over. If not, then you check the second condition. Were you in India for at least 60 days that year? And in the 4 years before that, did you stay for a total of 365 days or more? If yes, you're still considered a resident.
Let's make this real with an example. Meet Priya. She works in an IT company in Bengaluru. Last year, she was in India for all 365 days. So she obviously crossed the 182-day limit, right? That makes her a resident of India for that year. Honestly, most salary people living and working in India will fall right into this bucket.
So if you're going to remember just one number from this first check, make it this one, 182. Just think of it as the magic number. It's about half a year. If you hit 182 days in India, you are a resident. It's the cleanest and simplest way to know.
Okay, so you've passed level 1, you've figured out you're a resident. But hold on, the tax rules have one more little layer for us. Once we know you're a resident, we have to figure out if you're ordinarily resident or not ordinarily resident.
So what on earth is a resident but not ordinarily resident, or RNOR? The simplest way to think about it is this. It's a special status for people who meet the day count to be a resident this year, but haven't been living in India regularly for the past few years. You know, like an NRI who has just recently moved back home.
Now, to be what most of us are, a resident and ordinarily resident, or ROR, you have to pass both of these next two tests. First, you must have been a resident in at least 2 of the last 10 years. And second, your total stay in India over the last 7 years has to be 730 days or more. You've got to clear both hurdles.
So the logic here is super straightforward. If you're a resident for this year, but you fail even one of those 2 long-term conditions we just talked about, your status for the year automatically becomes RNOR. Simple as that. ROR, RNOR, non-resident. I know, it sounds like a lot of jargon. You're probably thinking, why do I even care about this? Well, this right here is the most important part of today's lesson. This status, this little tag, directly decides how much of your hard-earned money is actually taxable in India.
This table puts it all into perspective. Let's start at the top with Priya, our ROR. For her, her global income gets taxed in India. That means her salary from Bengaluru and the interest she earns from a fixed deposit in a U.S. bank are both taxable right here. But now look at Rahul, the RNOR, or Arjun, the non-resident. For them, it's generally only their Indian income that's taxed. So Rahul's Indian salary is taxed, but the rent he gets from his property in Dubai is not. And Arjun only pays Indian tax on the rent from his Mumbai flat. His salary from his job in Dubai is totally outside the Indian tax net.
So, if you boil it all down to one single crucial point, it's this. Your residential status is like a switch. It determines if your foreign income gets taxed in India or not. For an ROR, that switch is on. For an RNOR or a non-resident, it's usually off. And that, as you could imagine, is a huge, huge deal.
All right, let's do a super quick recap of the main points. 1. Your status can change every single year. 2. It's all about counting the physical days you're in India. And yeah, the day you land and the day you fly out both count. And finally, the most important one, this has absolutely nothing to do with your passport or your citizenship.
And there you have it, the foundation of residential status. So now that we know who pays tax and on what income, we can finally get to the really exciting part: how to legally pay less tax. This leads us perfectly into the next chapter of our course, Core Exemptions and Deductions. And we're going to start with a big one. something that affects pretty much anyone who pays rent. In our very next explainer, we're going to get into the details of Section 10 exemptions, and we'll focus especially on house rent allowance, or HRA. We'll figure out exactly how to use it to bring your tax bill down. So, I'll leave you with this final thought. Now that you know how a few days here or there can literally change your tax situation for an entire year, are you going to be keeping a closer eye on your travel dates on your next trip abroad? Something to think about. I'll see you in the next session.
Hello and welcome. In today's session, we're going to talk about something everyone wants to know. How can you legally pay zero tax on parts of your salary? Yep, you heard that right. We're going to use a super useful tool in the Income Tax Act called Section 10 to help you keep more of your hard-earned money. Welcome back to our course on smart tax planning. So, in Module 1, we broke down your salary slip, right? Today, in Module 2, we're diving into something really powerful, Section 10 exemptions. This is how parts of your salary can actually become tax-free. And you'll definitely want to stick around because next up, we're tackling the famous Section 80C deductions. You know that feeling, right? You see that big, impressive CTC number in your offer letter, but then you look at what actually hits your bank account, and it's a totally different story. Well, the biggest culprit for that gap is, of course, income tax. But what if I told you there's a totally legal way to protect chunks of your salary from the tax man? So here's our plan for today. First, we'll look at the parts of your salary that can be tax-free. Then, we'll uncover the magic of Section 10. After that, we'll do a deep dive into HRA and travel allowances, touch upon retirement benefits, and finally, we'll tackle that big, important question, old regime or new regime. Let's jump right in. Just imagine for a second, what if a part of your income was completely invisible to the tax authorities? I'm not talking about some shady loophole here. This is a list created by the government itself, and it's specifically designed to help salaried folks like you and me. And that special list, well, it's right there in Section 10 of the Income Tax Act. The best way to think of it is like a special chapter in the tax rollbook. It basically lists out all the different kinds of income that are completely exempt. That means they aren't even added to your total income when it's time to figure out how much tax you owe. Okay, now hold on. This is probably the most important thing you'll hear today. Almost all of these amazing benefits we're about to discuss are available only if you stick with the old tax regime. The new regime, it has lower tax rates, sure, but the catch is you have to give up most of these exemptions. Just keep that in the back of your mind. We'll come back to it. All right then, with that super important point out of the way, let's open up this treasure chest called Section 10 and see exactly what goodies are inside for salaried employees. So, you'll see there's a real mix of things here. You've got the big ones, the heavy hitters, like house rent allowance or HRA, and leave travel allowance, LTA. But even the small things really add up, you know? Like the children's education allowance, it's 100 rupees a month for up to 2 kids. Or food allowances, which can be tax-free up to 26,400 a year. And hey, if your company pays for your internet or travel for work, that's tax-free too. Okay, let's zoom in on the two biggest players here, HRA and LTA. Honestly, for most people, these two offer the biggest tax savings under Section 10, so it's absolutely crucial to understand exactly how they work. So, your salary slip says you get a certain amount as HRA, but does that mean the whole thing is tax-free? Well, the answer is almost always a big no. There's a special formula to figure out the tax-free part, so let's walk through it together. The rule is actually quite simple once you see it. Your tax-free HRA is the lowest of these 3 amounts. Just remember that word, lowest. First, the actual HRA you get from your company. Second, 50% of your basic salary if you live in a metro like Delhi or Mumbai, or 40% if you're in any other city. And third, the actual rent you pay for your house minus 10% of your basic salary. Whichever of these 3 numbers is the smallest, that's your tax-free HRA. Theory is one thing, but let's make this super clear with an example. So let's meet Anjali. She works in Mumbai. Her basic salary is 40,000 rupees a month. Her company gives her 20,000 as HRA, and she pays 15,000 rupees in rent. Let's figure out how much tax she can save. Okay, let's do the math for Anjali for the full year. Condition 1, the actual HRA she got. That's 2,40,000. Simple. Condition 2, she lives in Mumbai, a metro, so we take 50% of her annual basic salary, which also comes to 2,40,000. Now for the third one. We take her annual rent, which is 1,80,000, and we subtract 10% of her basic salary, which is 48,000. That gives us our final number, 1,32,000. So we have our three numbers, 2.4 lakhs, 2.4 lakhs, and 1.32 lakhs. Remember the rule? We have to pick the lowest one. So for Angela, 1,32,000 rupees of her HRA is completely tax-free for the year. Pretty cool, right? Only the balance amount will be taxed. All right, next up is LTA, and trust me, this one is much simpler. Let's say you take a family trip to Goa. The cost of your flight or train tickets to get there, that can be claimed as tax-free up to the limit your employer gives you. But, and this is important, it's only for the travel fare. The money you spend on your hotel, food, sightseeing, none of that is covered. You know, Section 10 isn't just about your monthly salary. It also gives you some major tax breaks during big moments in your career, like when you retire or maybe decide to leave a company. Just look at this. These are some serious benefits. When you leave a job or retire, things like gratuity and leave encashment have huge tax-free limits. I mean, up to 25 lakhs for leave encashment. Even the interest on your Provident Fund is usually tax-free. And if you take voluntary retirement, you can get an exemption of up to 5 lakhs. These are big numbers. So we've gone through all these fantastic tax-saving exemptions. And this brings us right back to that critical decision you have to make every single year. Should you go for the old tax regime or the new one? Let's just break it down really simply. The old regime has higher tax slab rates, but it's your key to unlocking all these exemptions we just talked about. HRA, LTA, the whole lot. The new regime gives you lower, simpler tax rates, but you have to say goodbye to pretty much all those benefits. So the choice is clear. If you pay a lot of rent or travel a lot, the old regime is probably your best friend. If you don't have those expenses, the simplicity of the new regime might just save you more money. So which one is right for you? There's only one way to know for sure. You have to do the math. Please don't just guess. The biggest takeaway here is to sit down and run the numbers for your own situation. Use an online tax calculator, compare both regimes, and see which one actually leaves more cash in your hand. So how do you actually get these benefits? It's really simple. Here's your 3-step action plan. Step 1, look at your salary slip and find these allowances like HRA and LTA. Step 2, collect all your proofs. That means your rent receipts, your flight tickets, everything. Keep them safe. And step 3, when it's time to file your income tax return, just make sure you declare this exempt income correctly. That's it. It's that straightforward. Okay, so we've learned how to make parts of our income totally tax-free using Section 10. That's a huge win. But tax planning doesn't stop there. The real question to think about now is, how can your investments like PPF or ELSS funds and your everyday expenses like your child's school fees or your home loan EMI cut down your tax bill even more? Well, that is exactly what we are going to cover in our very next lesson on Section 80C Deductions. I'll see you in the next class. Welcome back to our course on smart tax planning. In our last chapter, we really got into the nitty-gritty of your salary structure, right? From basic to HRA. Well, today, we're going to look at 2 super simple deductions that can boost your take-home pay. And the best part? No extra investment needed. Okay, let's get right into it. So, here's what we've got on the menu today. First, we'll talk about what I like to call the government's automatic discount for you. Then, we'll look at that small professional tax you've probably seen on your payslip. After that, and this is crucial, we'll see how these two play out in the big choice between the old and new tax regimes. And finally, we'll wrap up with the key things you absolutely need to remember. All right, first up, let's talk about something that's honestly like a free gift from the government to every single salaried person in India. Now, imagine this. What if I told you that you could get a tax discount on your salary without investing a single rupee or showing any bills, any proof, nothing? Sounds a bit too good to be true, right? But believe me, this is a real benefit available to everyone who earns a salary. 50,000 rupees. Yep, that's the magic number. It's a flat, straight-up discount that directly cuts down your taxable salary. Just think about it for a second. Before the government even starts to calculate your tax, they say, hey, just reduce your income by this much. No conditions, no messy paperwork. So the official name for this is the standard deduction. The absolute best way to think about it is like a flat discount on the MRP of something you buy in a store. If you earn a salary, or even if you get a pension, the government simply lets you chop off 50,000 rupees from your taxable income. No questions asked. It's fantastic.
Okay, now for the second deduction. You've probably scanned your monthly payslip and seen a small amount being cut under a short form, usually PT. Well, that stands for professional tax.
Now, this isn't an income tax that goes to the central government. Nope. This is a small tax that your state government charges just because you're working in that state. It's a really small amount, and here's the good news. By law, it can't be more than 2,500 rupees for the entire year. And even better, your company handles it all. They deduct it and pay it for you, so you don't have to worry about a thing. You know, every state has slightly different rules. Just to give you a simple example, let's take Karnataka. Over there, if your monthly salary is less than 25,000, you pay zero professional tax. But the moment your salary hits 25,000 or more, your employer will deduct 200 rupees every month. See, it's as straightforward as that. All right, now we're at the most important part of this chapter. How do these two deductions, the standard deduction and the professional tax, actually work in the old versus the new tax regimes? You'll want to pay close attention here because the choice you make directly affects how much tax you save. So here's where it all comes together. The really great news is that the 50,000 rupees standard deduction is now available in both the old and the new regimes. That is a huge plus for everyone. But, and this is a big but, the crucial difference is the professional tax. You can only claim a deduction for it if you choose to stick with the old regime. If you opt for the new regime, that little benefit is completely gone. So just to make it crystal clear, if you are in the old regime, that 2,500 rupees you pay to the state government isn't just an expense. It actually helps you save a little bit more on your income tax by lowering your total taxable income. It's a small advantage for sure, but it's definitely an advantage of the old system. Okay, let's do a quick fire round and recap the simple but really important points we've covered in this chapter. So here are the three main things to take away. Number one, the standard deduction is your automatic right. 50,000 rupees off your taxable income no matter which regime you're in. Easy. Number two, professional tax is just a small mandatory state tax. And number three, the most important one, your choice between the old and new regime is what decides whether you get a tax benefit on that small cost. So, today we've covered two really simple automatic deductions, but what about the bigger expenses? Like the huge amount of rent so many of us pay every single month. Can that become a tax saver? Oh, absolutely. Join me in the next chapter where we will tackle house rent allowance, or HRA, and I'll show you exactly how to turn that big expense into a major tax saving. See you there. All right, let's be real for a second. If you're earning a salary in India, chances are tax season gives you a massive headache, right? But what if I told you it doesn't have to be that way? Today, we're going to look at how you can stop being confused by taxes and actually start saving money. So let's jump right in. You know the feeling? You work hard the whole year, you get your salary, and then bam,
It's that time again. You're trying to figure out all these deductions, exemptions, and you're just hoping you've done it all right. It's super overwhelming, isn't it? Well, trust me, you are definitely not alone in feeling that way. So, what's the solution? Imagine having a simple guide, a roadmap that helps you not just file your taxes, but actually plan them smartly. A way to turn all that stress into real confidence. Well, that's exactly what we're diving into. And here it is. We've put together a course called Smart Tax Planning for Salaried Employees in India. It's built from the ground up, just for people like us, salaried folks. Seriously, think of it as your personal guide to finally getting a handle on your taxes. So, how does this all work? Well, it's a journey, really. We've laid it all out, step by step, to take you from feeling totally lost to being in complete control. Okay, so we start right at the beginning in Module 1, building your foundation. I mean, you can't save tax if you don't even understand your own salary slip, right? Then, in Module 2, we jump into the core deductions. These are the big ones, the easy wins. Once you've got that down, we get into the more advanced deductions. Then it's all about linking this to your investment planning. And finally, the last step, we bring it all together so you can file with confidence. It's a logical path. Now, to give you a real taste of how practical this is, let's do a little sample class. We're going to pull a topic straight from Module 2, Core Exemptions and Deductions, and we're going to talk about a tax-saving trick that, honestly, a lot of people miss out on. All right, so our spotlight is on a nifty little section of the tax law, Section 80GG. So what's that? Well, this is for anyone who pays rent but doesn't get that house rent allowance, HRA, from their company. It's a super common situation, but believe me, it's also super misunderstood. So what is Section 80GG, really? Just think of it like this. It's the government's way of giving a tax break to people who pay rent but don't get HRA in their salary. And it's not just for salaried people. Self-employed folks can use it too. Now, here's a really key difference you have to get. HRA is for salaried people who see that HRA component on their payslip. Section 80GG, on the other hand, is for people who pay rent but do not have HRA. And the rule is crystal clear. You can claim one or the other, but never both. And listen, if your company gave you even one single rupee as HRA during the year, sorry, you can't use 80GG. So, who can actually claim this? Let's run through a quick checklist. First, and most obvious, no HRA from your employer. 0. Second, neither you nor your spouse nor your young kids can own a house in the city where you work. Makes sense, right? And third, there's a little bit of paperwork. You have to file a special form online called Form 10BA. Let's make this real with an example. So say there's Amit. He's working at a startup in Pune, living in a rented apartment. His company's salary structure doesn't include HRA. Well, for someone like Amit, Section 80GG is an absolute lifesaver at tax time. Okay, the big question, how much can you actually save? The number to remember is 5,000 rupees a month. That's the maximum. But wait, how do they calculate the exact amount you can claim? It's pretty simple, actually. You have to figure out 3 numbers, and your deduction will be the lowest of the 3. Okay? So, number 1 is that flat 5,000 rupees per month. Number 2 is 25% of your total income. And number 3 is the actual rent you paid minus 10% of your income. You calculate all 3, pick the smallest one, and boom, that's your deduction. Okay, listen up because this is super important. You can only get this 80G benefit if you choose the old tax regime. I'll say it again. This deduction is not available under the new tax regime. So if you switch to the new one, you can't claim this. And one more thing you absolutely cannot forget. It's not enough to just do the math. You have to file that Form 10BA online. It's basically you telling the tax department, hey, I meet all the conditions for this. And you've got to do it before you file your main tax return. Please don't leave this for the last day. Okay, here's a question I get all the time. Can I pay rent to my parents and claim 80GG? And the answer is yes, you absolutely can. It's totally legal, but you have to do it by the book. That means you need a proper rental agreement and you must make the payments through bank transfers, not cash. This creates a proper paper trail. And of course, your parents will have to declare that rent as their income when they file their own taxes.
So there you have it. That was just one small lesson from Module 2. But the full course, wow, it goes so much deeper, covering pretty much everything a salaried person in India needs to know about taxes. So what else will you learn? We'll dive deep into saving tax on your home loan interest. We'll help you pick the best tax-saving investments for you, whether it's ELSS funds or good old PPF. You'll finally be able to look at your Form 16 and actually understand what it all means. And, of course, we'll tackle that million-dollar question. Should you choose the old or the new tax regime? We break it all down with real examples. You see, the whole point of this isn't just to save a little tax this year. The real goal is to give you the knowledge to be your own tax expert for life. It's about empowering you. So what's the end game? What do you walk away with? You'll know exactly how to legally maximize every single deduction. You'll optimize your investments for better returns and tax savings. You'll be able to file your return confidently without any mistakes. And the best part, all of this means you actually increase your take-home salary, more money in your pocket. Look, this kind of knowledge is power. It gives you control over your own money. So instead of dreading that time of year, the only question left is, are you ready to take control of your finances? Hey everyone, welcome to our course on smart tax planning for salaried employees in India. Today, we're going to unlock one of the most powerful tools you have for saving tax, the famous Section 80C. Let's jump right in. Welcome back. In our last lesson, we broke down the House Rent Allowance, or HRA. Today, we're moving on to another giant from Module 2, Section 80C. Honestly, if you're a salaried person in India, you have to think of this as your tax-saving superpower. It's that important. So what is this Section 80C that you hear everyone talking about? Let's make it super simple. The easiest way to think about it is like a special discount coupon that the government gives you on your final tax bill. So here's the deal the government makes with you. It says, hey, if you save or spend your money on these specific approved things, we'll pretend you earned less money. And when your taxable income goes down, your tax bill goes down too. It's basically the government's way of encouraging us to save for the future, for things like retirement or our kids' education. Okay, but here is the single most important thing you need to remember. This is absolutely crucial. This entire superpower, this Section 80C benefit, is only available if you choose the old tax regime. If you've opted for the new regime, I'm sorry, but this deduction is off the table. So your choice of tax regime is literally the key that unlocks this massive benefit. All right, now that we know what 80C is, let's look at where you can actually put your money to claim this benefit. And the great thing is, it's not just one or two options. It's like a whole menu of choices, and you can pick what works best for you. So what's actually on this menu? Let's check out some of the most popular options that people like us use every single year. And wow, look at the variety here. If you're okay with a bit of market risk and want higher growth, you've got ELSS mutual funds. If you want something super safe and long-term, the Public Provident Fund, or PPF, is a fantastic choice. You can even claim deductions for important expenses, like your life insurance premium, the principal part of your home loan EMI, and even your children's school fees. For those who like it simple with guaranteed returns, there's the 5-year tax-saving FD. And there's specific schemes too, like the Sukanya Samriddhi for saving for a daughter's future. There's really something for everyone. Okay, so we know what it is and where to invest. But the next big question is how much? When it comes to Section 80C, there's one magic number that you just have to burn into your memory. And that number is 1,50,000 rupees. This is it. This is the maximum amount you can reduce from your taxable income using Section 80C in a single financial year. It's the absolute limit. Now, here's a brilliant way to think about this limit. Imagine you have a shopping basket. You can go around that menu we just saw and pick whatever you want. Put in some PPF, add your life insurance premium, throw in your home loan principal. You can put all of it into your basket. But when you get to the checkout counter, the tax department will only give you a discount on a total of up to 1.5 lakhs. It's the total of everything in the basket that matters, not each individual item.
But wait, there's actually a little bonus here. For those who want to be extra smart about their tax planning, there's a way to save even more on top of that 1.5 lakh limit. And this extra benefit comes from investing in something called the National Pension Scheme, or NPS. There's a special little subsection, 80CCD1B, that lets you claim an extra 50,000 rupees deduction. And the best part? This is totally separate from your 1.5 lakh basket. So in total, you can actually claim a deduction of up to 2 lakh rupees. It's a fantastic way to save more tax and build your retirement fund at the same time. All right, theory is one thing, but let's see what this looks like in the real world. Because at the end of the day, it's about how much money you actually save, right? So let's take a very practical example. So let's meet Mr. A. He's a salaried guy, and his total income for the year is 10.5 lakh rupees. Now, Mr. A is a smart planner, so he's invested the full 1.5 lakh in his PPF account. Let's see what a difference that makes to his tax outgo. Just look at this side by side. On the left, if Mr. A does nothing, his entire 10.5 lakh is taxable, and he pays about 1,32,000 in tax. Now look at the right. Because he made that 1.5 lakh investment, his taxable income drops straight down to 9 lakh rupees. And look what that does to his tax bill. It falls all the way down to just 96,200. That's a direct saving of 36,400 rupees. That's real money that stays in his bank account instead of going to the tax man, just because he planned ahead and used Section 80C. So the bottom line is simple. By using Section 80C to its full potential, Mr. A saved a clean 36,400 rupees. This isn't just theory. This is the real cash benefit of planning your taxes smartly. Okay, so you've seen the numbers, you're convinced, and you want those savings for yourself. But how do you actually do it? Let's get to the most practical part, your simple 4-step action plan to claim this deduction. Step 1, and this is non-negotiable, make sure all your investments are done before the financial year ends on March 31st. Don't leave it for the last day. Step 2, gather your proofs. Keep your receipts, your account statements, your certificates, basically any piece of paper that proves you made the investment. Step 3, submit these proofs to your employer, usually around January or February. This is important because they'll adjust your TDS, meaning they'll cut less tax from your salary for the last couple of months. And finally, step 4, you have to declare all these deductions again when you file your income tax return, or ITR. And there you go. You've officially mastered the ABCs of Section 80C. In our next lesson, we're going to jump into Module 3 and explore some advanced deductions, especially the big benefits you get from home loans and education loans. But for now, I want to leave you with a question to think about. Looking at that investment menu, what's the perfect mix for your personal goals and your life situation? Think about it. Thanks for joining me, and I'll see you in the next class.
Hey everyone, and welcome back to our course on smart tax planning. In today's class, we're going to tackle something really important, Section 80D. This is a fantastic tool that helps you protect both your family's health and your hard-earned money.
All right, let's jump right in. Today is all about understanding the link between your health and your tax savings. Honestly, this is a topic that's absolutely essential for every single one of us.
So, in our last class, we went deep into Section 80C, which was all about investments, right? Today, we're shifting gears to focus on health and insurance with Section 80D. And just a little preview, in our next class, we're going to talk about saving tax on some really big life goals, like home loans and education loans. You don't want to miss that.
Okay, so here's our roadmap for today. First, we'll cover the absolute basics of Section 80D. Then we'll get into the numbers, how much you can save. We'll walk through a real-life example to make it super clear, cover some must-know rules, and then we'll wrap up with the key points to remember.
So what's the big idea behind Section 80D anyway? Well, to put it simply, you can think of it as the government's way of giving you a little reward for taking care of your health and getting insurance. In plain and simple English, Section 80D is a tax benefit that lets you lower your taxable income. You get to claim a deduction for money you've spent on health insurance. I really like to think of it as a small thank you, or maybe a discount, from the government for being proactive about your family's well-being. Okay, so you might be wondering, whose expenses can I actually claim? Well, this covers quite a few people. You can claim the premiums you pay for yourself, for your spouse, for your children who are dependent on you, and, this is a big one, for your parents as well. And what kind of expenses are we talking about here? Well, the main one, obviously, is your health insurance premium. But that's not all. It also covers medical expenses for your senior citizen parents if they don't have an insurance policy. And it even includes a small benefit for those annual preventative health checkups. All right, let's get to the part everyone's really interested in, the money. You know, with medical costs going up every year, this section is more important than ever. So let's break down how much tax you can actually save. Now pay close attention because this is where you can see some serious savings. Let's look at the first row. If you and your parents are all below 60, you can claim 25,000 rupees for your family and another 25,000 for your parents. That's a total of 50,000 rupees. Now watch what happens when your parents are senior citizens. That's over 60. Your limit stays at 25,000, but their limit doubles to 50,000. That brings your total possible deduction up to 75,000. And in the final scenario, if both you and your parents are senior citizens, you can claim up to a whopping 1 lakh rupees. That's a huge benefit. Now, remember those preventative health checkups we talked about. You can claim up to 5,000 rupees for them. But, and this is a really important point, this 5,000 is part of your overall limit. It's not an extra deduction on top of the 25,000 or 50,000. It's included within that main limit, okay? Okay, all this theory is great, but let's make it real. The best way to understand how these numbers actually work is to look at a proper example. So let's meet Rohan. He's 45, a typical salaried person just like many of us. He pays a premium of 30,000 rupees for himself and his family. He also takes care of his dad, who's 75, and pays 35,000 rupees for his father's insurance policy. So the big question is, how much can Rohan actually claim as a deduction? Let's break down Rohan's calculation. For his own policy, he paid 30,000 rupees. But because he's under 60, his claim is capped at the 25,000 rupee limit, so he gets to claim 25,000. Now, for his 75-year-old father, the limit is 50,000 rupees. Since he only paid 35,000, which is under the limit, he can claim the full amount. So, you just add them up. 25,000 for himself plus 35,000 for his father. That gives him a total deduction of 60,000 rupees. See? Pretty simple when you break it down. Knowing the numbers is half the battle, but knowing the rules is the other half. So let's cover the fine print that you absolutely must remember to get your claim right and avoid any issues later. Okay, everyone, listen up, because this is probably the most important rule of them all. This fantastic deduction we've been talking about, Section 80D, it is only available if you choose to file your taxes under the old tax regime. If you've opted for the new tax regime, you have to give up this benefit. So it's really, really important to choose your regime wisely. Next up, how you pay the premium is also super important. For your health insurance premium, the payment must be made through any mode except cash. So you can use net banking, your card, UPI, a check, anything with a digital trail. If you pay your premium in cash, you cannot claim the deduction. The only small exception here is for those preventive health checkups. For that, cash payment is allowed.
It's also really important to know who is not covered. You can't claim this deduction for premiums paid for your brother or sister or for your grandparents. If your children are working and earning their own money, they're not considered dependent anymore, so you can't claim for them either. And one last thing, that group insurance your company provides, since your employer is paying that premium, not you, you can't claim a deduction for it.
Phew, we've covered a lot today. So let's just take a moment to quickly recap the most important takeaways from today's lesson. These are the points I really want you to remember.
So here's the summary. 1. Section 80D is a total win-win. You protect your family's health and you save on taxes. 2. The deduction can be quite large, going all the way up to 1 lakh rupees, depending on your age and your parents' age. 3. And I'll say it again because it's so important, this benefit is only for those who choose the old tax regime. And 4, please remember to pay your premiums online or through a bank, not in cash.
So, with Section 80D, you've now got a solid plan for your family's health and your tax savings. That's a huge step. But what about those other big dreams, like buying your own home or funding higher education? Did you know they can also be powerful tax-saving tools? Well, that is exactly what we're going to dive into in our next class. It's going to be a great session, and I can't wait to see you there. Let's talk about how to turn one of your biggest monthly expenses, your loan payments, into one of your biggest tax-saving tools. Sounds good, right?
All right, welcome back to class. In Module 2, we covered all the core deductions like Section 80C. Today, in Module 3, we're getting into some really powerful stuff, the advanced deductions. And you'll definitely want to stick around because in our next module, Module 4, we'll dive into how to link your investments to your tax planning.
You know, for most of us, after the tax is cut from our salary, the biggest thing eating into our bank account is a loan EMI. It could be a home loan, an education loan. It's a huge chunk of our money. But what if I told you that those same EMIs could actually bring your tax bill down? Let's break down exactly how you can make that happen. Okay, first up is a fantastic one, the education loan benefit under Section 80E. This is brilliant because it covers so much. Maybe you've taken a loan for your child's college, your spouse's master's, or even for your own upskilling course. The interest you pay on that loan can be directly subtracted from your taxable income. So who gets to claim this? The rules are actually pretty simple. It has to be you, an individual, not a company. The loan can be for yourself, your husband or wife, or your kids. Now here's a key point. The loan must come from a proper financial institution like a bank, not from your uncle or a friend. And remember this, it's super important. This deduction only works if you choose the old tax regime.
Now, here's something you have to get right. Your EMI has 2 parts, right? The principal, which is the actual loan amount you're paying back, and the interest, which is kind of like the bank's fee. The tax benefit is only on the interest part. Think of it like this. The government is helping you out with the cost of running the car, not the cost of the car itself. And now for the absolute best part. You know how other deductions like 80C have a limit of 1.5 lakhs? Well, with Section 80E, there's no limit. Absolutely none. If you paid 2 lakhs, 3 lakhs, whatever amount in interest in a single year, you can claim the entire thing as a deduction. That's a huge, huge benefit.
Okay, there is one small catch, and it's about time. You can claim this deduction for a maximum of 8 years. That clock starts from the year you make your first repayment. So you get it for 8 years or until you've paid off all the interest, whichever happens first. If your loan is for just 6 years, then you get the benefit for those 6 years. All right, let's move on to the big one, the one that affects so many Indian families, the home loan. This is probably the biggest loan most of us will ever take. And the good news is, the tax benefits that come with it under Section 24 are also pretty big.
Yeah, listen closely because the rules are completely different depending on what you're doing with the house. If you live in the house yourself, that's called self-occupied, you can claim a deduction of up to 2 lakh rupees on the interest you've paid. But this is only in the old regime. Now, if you've given the house on rent, guess what? There is no limit on the interest deduction. And the best part? This benefit for a rented house is available in both the old and the new tax regimes. That's the key difference.
Let me give you a quick example just to make it clear. Let's say for the house you live in, you paid 2.5 lakh rupees in interest this year. Even though you paid more, the maximum you can claim as a deduction under Section 24 is capped at 2 lakh rupees.
But wait, there's more. Well, for some of you at least. If you bought your very first home a few years back under an affordable housing scheme, the government gave out a special bonus deduction. It's under a section called 80EEA. Now, this bonus had some very specific conditions. It had to be your very first house. The value of the property couldn't be more than 45 lakhs. And this is the most important part. The loan had to be approved within a very specific window between April 1st, 2019 and March 31st, 2022. So if your loan fits that timeline, you might just be in luck. So, what was this amazing bonus worth? It was an extra deduction of up to 1,50,000 rupees. And remember, this is on top of the 2 lakh limit we just talked about.
This is where the magic really happens because you can stack these benefits. You take the 2 lakh rupees from Section 24, you add this 1.5 lakh bonus from 80EEA, and your total deduction on home loan interest suddenly jumps to 3.5 lakh rupees. That is a massive, massive tax saving.
Okay, class, pop quiz time. We've just talked about all these amazing deductions, but they're only useful if you choose the right tax regime. So, which one is it? Old or new? Let's check the scorecard. Just look at this table. The story it tells is crystal clear, isn't it? Almost every single major loan deduction, the education loan, the interest on the house you live in, that first home bonus, all of it gone if you choose the new regime. The only exception is the interest you pay on a rented-out house. So if you have these loans, choosing the old regime could literally save you lakhs of rupees. All right, class is almost over, but before you pack up your bags, I have some very simple homework for you. This isn't difficult, I promise. It's just to make sure that you can put everything we learned today into action and get the biggest tax refund you possibly can. Here's your simple 3-step action plan. First, get your loan interest statements from the bank. They usually email them out, so check your inbox. Second, just add up all the interest you paid. That number is your total potential deduction. And third, the most important step, when you're filing your taxes, if you have these loans, make sure you tick the box for the old tax regime. It's really that simple. So there you have it. You now know how to make your liabilities, your loans, work for you to save tax. But what about your assets, your investments? Can we make those tax efficient too? You bet we can. And that is exactly what we'll be covering in our next class, Module 4, Investment-Linked Planning. I'll see you then. Hello everyone and welcome back. We're diving right into another lesson from our course on smart tax planning. Today, we are going to unlock a really powerful tax-saving secret that, believe me, a lot of people miss out on. So, let's get started. All right, so in our last class, we figured out how you can save some serious tax on your home and education loan EMIs. Today, we're going to switch gears and look at your future. This is a super important topic. Planning for retirement using something called the National Pension System, or NPS for short. Okay, let's start with a problem I bet many of you have faced. It's that time of the year. You've put your money into your PPF, maybe some of those tax-saving mutual funds, you know, ELSS, and bam, you've hit that famous 1.5 lakh limit under Section 80C. So you lean back and think, phew, that's it, my tax saving is done. But
Is it really? What if I told you there's another bucket? A special, kind of secret bucket for tax saving that sits completely separate from that 1.5 lakh one. Yeah, there's a special provision that so many salaried folks in India just don't know about. Okay, let's get into it. Everyone, meet your new best friend for tax planning, Section 80 CCD 1B. Seriously, remember this name. It's a special section in our tax law that gives you an extra tax deduction. We're talking up to 50,000 rupees just for investing in the national pension system. So how does this actually work? It's honestly so simple. Step 1, you do what you always do. Fill up your usual 1.5 lakh bucket with your PF, your kids' school fees, life insurance, all that stuff. Then, step 2, you invest an additional 50,000 rupees into your NPS account. And the result? You can now claim a total tax deduction of a full 2 lakh rupees. It's that easy. Let's make this real with an example. Picture Rohan. He works at an IT company in Bangalore. He's a smart guy. He's already maxed out his 1.5 lakh ATC limit with his PPF investment. But he knows about this extra bucket. So he opens an NPS account and puts in another 50,000. And just like that, poof, his total taxable income is now reduced by 2 lakh rupees. And just to be clear, this isn't some shady loophole or a gray area. The law itself says it, black and white. It clearly states that this 50,000 rupee deduction is over and above the regular 1.5 lakh limit. They are two totally separate benefits.
Now hold on. Before you get too excited and rush off to open an NPS account, just wait a minute. There is one, and I mean one, very important rule you absolutely need to know. This amazing benefit, well, it's not available to absolutely everyone. It all depends on which tax system you've chosen for yourself.
So here it is, the big one. This extra 50,000 rupee deduction, it's a special privilege only for people who are following the old tax regime. If you've decided to go with the new tax regime with its simpler structure and lower rates, then I'm sorry, but you can't claim this extra NPS benefit. You know, this table really helps make sense of it all. See, the NPS benefits are actually split into 3 parts. First, you've got Section 80 CCD1. This is for your own contribution, and it gets bundled inside your regular 1.5 lakh limit. Then, there's Section 80 CCD1B. That's our hero for today. This is that special one, giving you the extra 50,000 rupee deduction. And finally, check out 80 CCD2. This is for when your company contributes to your NPS. And the best part? The deduction here has no upper limit. That's another really powerful tool. Okay, one more key detail. When you go to open an NPS account, you're going to see 2 options, Tier 1 and Tier 2. To get this specific 50,000 rupee tax break we're talking about, your money absolutely must go into the Tier 1 account. So what's the difference? It's simple. Think of the Tier 1 account as your main retirement piggy bank. It's locked up tight until you turn 60, and this is the one that gives you that sweet tax benefit. The Tier 2 account, on the other hand, is more like a flexible savings account. You can put money in, take it out whenever you want, but you don't get this special tax deduction on it. All right, let's just quickly recap the 4 golden rules. 1. This is for everyone, whether you have a job or you're self-employed. 2. You've got to be an Indian citizen between 18 and 70. 3. The money has to go into a Tier 1 account. And 4, the most important one, you must be in the old tax regime. Got it?
And let's not forget the bigger picture here. I mean, saving tax today is awesome. It feels great. But the real purpose, the whole reason the national pension system exists, is to help you build a solid fund for your retirement. It's a government-backed scheme to make sure you have a regular income long after you've hung up your boots. The tax saving? Well, that's just a fantastic bonus.
So after all the sections, the rules, the tiers, what's the one thing, the one number I want you to take away from our lesson today? It's this one, 50,000 rupees. That's your extra deduction, your extra saving, your extra power to lower your tax bill every single year. All you have to do is use this NPS benefit under the old tax regime. Please don't leave this money on the table.
Awesome work! You now know a really powerful strategy to save for your future and cut down your taxes at the same time. But hey, our course isn't over yet. In our very next chapter, we're going to explore some other interesting deductions you might be missing out on, like the money you donate to charity or even the small interest you earn from your bank account. See you in the next class!
Hey everyone, and welcome. So, you're looking for some smart, simple ways to save on your taxes, right? Well, you've come to the perfect place. Welcome back to our course, Smart Tax Planning for Salaried Employees in India. Today, we're jumping into a really important chapter from Module 3, which is all about advanced deductions. These are the ones that, honestly, so many people just don't know about. So let's get you ahead of the curve. So what's on the agenda today? It's pretty straightforward. First, we'll talk about how giving back can actually save you tax. Then there's a special bonus just for our senior citizens. We'll also cover a really important deduction that offers support when it's needed most. And then, of course, we'll wrap it all up with the key things you absolutely need to remember. All right, let's kick things off. First up, giving back and saving tax with Section 80G. You know, this is one of those wonderful parts of our tax law that actually rewards you for doing good. It's a way of saying that your generosity can also help lower your tax bill. So, what on earth is Section 80G? Honestly, the easiest way to picture it is like this. Think of it as a thank you discount from the government for being generous. When you donate money to certain approved charities and funds, the government lets you chop that amount off your taxable income. Pretty cool, right? Okay, now there are a few rules, and you've got to follow them to the letter. It's simple stuff, really. Your donations should always be through a bank. Check, online transfer, that sort of thing. If you're giving cash, there's a tiny limit of just 2,000 rupees. And here's something important. Donating things like food or clothes, which is an amazing thing to do, doesn't count for this specific tax break. And the most crucial part, the absolute non-negotiable, you must get a proper receipt from the charity. It needs to have their PAN and registration number. Without that piece of paper, you can't claim anything. So you're probably thinking, okay, where should I donate to get the best tax benefit? Good question. For a full 100% deduction, where every single rupee you give is cut from your taxable income, you can look at well-known funds like the PM CARES Fund, the Swachh Bharat Kosh, or even your own state's Chief Minister's Relief Fund. Let's make this super clear with a quick example. Meet Ravi, an engineer from Bengaluru. He goes online and donates 5,000 rupees to the PM CARES Fund. Simple, right? Well, when it's time to file his taxes, he can reduce his total taxable income by that entire 5,000 rupees. It's literally that straightforward. Okay, now I need you to listen really, really closely. This is probably the most important thing I'll say about this section. This tax benefit, this wonderful deduction, is only available if you choose the old tax regime. I'll say it again. If you're in the new tax regime, you cannot claim this. This is a huge factor when you're deciding which regime is better for you. All right, moving on to our next topic. This one's a special benefit, and it's something I think is really well-deserved. It's a bonus just for India's senior citizens, and it's called Section 80 TTB. And trust me, it's a game changer. So what is Section 80 DTB? Well, it's basically a special deduction for our resident senior citizens. That means anyone who's 60 or older. It's designed to give them a break on the interest they earn from their deposits, whether that's in a bank or a post office. So, how much better is this deal for seniors? Let's break it down. For most of us, there's a section called 80 TTA, which lets you deduct up to 10,000 rupees, and only on savings account interest. But for senior citizens under 80 TTB, wow, the limit jumps to 50,000 rupees, 5 times more. And it's not just for savings accounts.
It covers all deposits, including those all-important fixed deposits. Yep, you heard that right. 50,000 rupees. For so many retired folks who rely on the interest from their FDs, this is a huge, huge relief on their tax bill.
Let me give you an example. Imagine Sunita, a retired teacher living in Pune. Let's say her fixed deposits earn her 60,000 rupees in interest in 1 year. Now, because of Section 80 TTB, she can claim a deduction of 50,000 rupees. So what does that mean? She only has to pay tax on the remaining 10,000, not the whole 60,000. That's a massive saving.
And you guessed it, just like the donation benefit, you have to remember this critical point. This fantastic deduction is exclusively a benefit of the old tax regime. It is simply not available if you opt for the new regime. Keep that in mind. Okay, let's move on to our final section for today's lesson. This one is all about providing strength and support through the tax system. We're going to talk about Section 80U, which offers financial relief for individuals with disabilities. So, what exactly is Section 80U? It's a very straightforward flat deduction. If you're a resident of India and you have a medical certificate that says you have a disability of 40% or more, you're eligible to claim this deduction from your income. Now, people often get confused between Section 80U and another one called 80DD. Let me make it super simple for you. You use 80U if you yourself have a disability. You use 80DD if you're spending money to care for a dependent family member, like your spouse, child, or parent, who has a disability. Same goal, different situations.
The deduction amount is fixed and it comes in 2 levels. If the disability is certified at 40% or more, you get a flat deduction of 75,000 rupees. But if it's a severe disability, which is defined as 80% or more, that deduction goes all the way up to 1,25,000 rupees. And you know, the best part about this section is how simple it is. It's a flat deduction. That means you don't have to collect bills, you don't need to show proof of expenses for medicines or anything. The only thing you need is that valid medical certificate, which is called Form 10-I. And for the last time today, I'm going to repeat the most important theme of this entire chapter. This vital support, this deduction under Section 80U is, once again, only available if you are filing your taxes under the old tax regime. All right, that covers the main content for today's lesson. We've gone through 3 really powerful but often missed deductions. So let's just take a moment to recap the key takeaways, the things you absolutely must remember. Okay, here's what you need to lock in. First and foremost, 80G for donations, 80TTB for senior citizens' interest, and 80U for disability are only in the old tax regime. Got it? Good. Second, your paperwork matters. Keep those donation receipts and medical certificates safe. Third, a special shout out for our senior citizens. You get that fantastic 50,000 rupee deduction on interest income. And finally, please take a moment to check if you or someone in your family might be eligible for these. They're often overlooked, but they can make a real, tangible difference. I really hope this deep dive into advanced deductions has been helpful. If you're feeling confident with this, get ready because our journey continues. In our next chapter, we'll be starting Module 4, which is all about investment-linked tax planning. We're going to explore how things like ELSS and PPF can not only help you build wealth, but also save you a ton of tax. So definitely stay tuned for that. But for now, I want to leave you with this one thought. You've just learned about 3 powerful tax-saving tools that most people don't even know exist. So the question for you is, which one of these will you look into first to make your own tax planning a little smarter this year? Have a think about it. Thanks for joining me today. Hey everyone, welcome back. If you are earning a salary in India, then listen up because this session is one of the most important ones for you. We're going to cut through all the confusion about where to invest your money, not just to save some tax, but to actually grow your wealth. Okay, let's get right into it. So this is the first thing we need to tackle, right? It's the big question on everyone's mind. The government now says the new tax regime is the default. It's got those lower tax rates, but it takes away almost all our deductions. So you're probably thinking, wait, is tax saving even a thing anymore? And the answer is a huge resounding yes. Understanding why is literally the key to building your wealth. And that brings us to the main idea of our class today. Welcome to Module 4, Chapter 12 of our course on smart tax planning. I want you to stop thinking of the old tax regime as old. Think of it as a strategic choice, a powerful option you have. See, when you choose the old regime, you unlock this entire toolkit of investments that the government actually wants you to use. This isn't about finding loopholes, it's about using tools designed for creating wealth. So remember this, we're talking about smart investing first, and the tax saving is the awesome bonus. Okay, so let's jump in and meet the main players in this game. We're going to break down the two most popular options you have under Section 80C if you choose the old regime. And I promise, no complicated jargon here. First up, we've got ELSS. Now, I know the name sounds a bit technical, right? Equity-linked savings scheme? But forget the name. All it is a special type of mutual fund. It takes your money and invests it in the stock market, in big Indian companies. And because you're investing, the government gives you a tax break. Simple as that. Now look at what makes ELSS so special. The lock-in period is just 3 years. That's the shortest you'll find for any tax-saving investment. The returns? Well, they're linked to the stock market, which means the potential is high. We're talking maybe 10 to 12% over the long run. But, and this is a big but, it also means the risk is high. The market goes up, it goes down. So think of ELSS like an express highway for your money. It's fast, it can get you to your goal quicker, but yeah, there might be a few bumps on the road. It's fantastic if you're young and have time on your side. All right, now let's go to the other end of the playground. Here we have the good old PPF, the Public Provident Fund. This is as safe as it gets. The key words to remember here are Government of India and guaranteed returns. This is all about safety, security, and peace of mind for your money. And you can see the difference right away, can't you? The lock-in for PPF is a long 15 years. The returns are fixed by the government, usually around 7 to 8%, and the risk, it's practically zero. It's backed by the government. So if ELSS was the fast express highway, PPF is like a safe, steady local train. It's not the fastest, but you know for sure it will get you to your destination safe and sound. It's perfect for anyone who just doesn't want to take any risks. So we have speed with a bit of risks on one side and total safety with a lot of patience on the other. How on earth do you choose? Well, it all comes down to finding your balance between 3 things: risk, reward, and that all-important lock-in period. Let's really visualize this, starting with how long your money is stuck. With ELSS, your money is tied up for just 3 years. That's pretty short, which means you can get your cash back relatively quickly if you need it. Now with PPF, you're looking at a much, much bigger commitment. 15 years. You really have to be sure you won't need that money for a very long time. And just to give you perspective, there are other retirement options like the National Pension System, or NPS, where your money is locked in until you're 60. This really shows how important it is to think about liquidity. Basically, how fast can you get your hands on your own money? Okay, this table puts everything in one place. It's like your cheat sheet. You can see ELSS right there at the top. Short lock-in, high potential returns, but also high risk. Then look at PPF, very low risk, and that beautiful EEE status. What does that mean? It means it's exempt, exempt, exempt. The money you invest is tax deductible, the interest you earn is tax-free, and the final amount you get back is also completely tax-free. It's amazing. Now compare that to, say, a 5-year tax-saving FD. The interest you earn on that is fully taxable, just like your salary. And with ELSS, Any profit you make over 1 lakh rupees in a year gets taxed at 10%. See how different they all are?
All right, enough theory. Now you know the options, let's get practical. The smartest move isn't about choosing just one. It's about creating a mix, a cocktail that's perfect for you. Let's talk about how to build that perfect mix based on where you are in life. Look, it's pretty simple. Your goals and how much risk you're willing to take will change over time. If you're young, under 35, you've got decades of earning ahead of you. You can afford to take more risks for higher growth. That means leaning more towards ELSS. Now, if you're in your mid-career, say 35 to 50, you probably want a bit of a balance, right? Some growth from ELSS and some safety from PPF. And of course, as you get closer to retirement, protecting the money you've saved becomes the #1 priority. So you'll naturally shift more towards super safe things like PPF and FDs.
You know, all this talk is great, but let's see how it works for a real person. So let's meet Mr. Raj. He's 30, a software engineer, earns a good salary, and he's decided to stick with the old tax regime. So let's get inside Raj's head. He needs to invest 1 lakh rupees more to get his full 1.5 lakh deduction under Section 80C. Instead of just dumping it all in one place, he gets smart. He puts 60,000 rupees into ELSS. Why? Because he's young, he wants that high growth potential for a long-term goal, maybe a down payment for a flat. But he also puts 40,000 rupees into PPF for that guaranteed safety and stability. So what's the result? He gets his full tax deduction, and he's building a smart, balanced portfolio that's working for his future. That's the key.
Phew, okay, we covered a lot of ground there. Let's quickly recap the most important points, and then I'll tell you what's coming up next in our course. So, if you only remember a few things from today's class, let it be these. 1. The old regime isn't old, it's a strategic choice for wealth building. 2. Don't put all your eggs in one basket. You need a balance between growth, like ELSS, and safety, like PPF. 3. Your mix is your mix. It depends on your age, your goals, and your comfort level with risk. And finally, the most important one, please start thinking of these as investments first and tax-saving tools second. The tax saving is just the cherry on top.
Awesome. So now you know how to choose your investments. Remember, in our last class, we figured out the whole residential status thing, and you are definitely not going to want to miss our next chapter. We're going to talk about something really powerful, how to work with your employer on smart salary structuring to legally increase your take-home pay. It's a game changer. And with that, we'll wrap up this class. But I want to leave you with some homework, a question to really think about. Now that you know the options, based on your age, your income, and what you dream about for your future, what does your ideal investment mix look like? Is it 50-50, 70-30? The power to design your financial future is in your hands. Happy investing!
Welcome back, everyone, to our course on smart tax planning for salaried employees in India. We're now in Module 4, which is all about investment-linked planning. And today, we're tackling a big one, a question that trips up so many people. Should you mix your insurance with your investments? By the end of this session, you're going to have a crystal clear answer. So let's just get right into it with the most important question you'll probably face in your financial life. You've heard it, right? From your bank manager, from an agent who calls you up. Sir, madam, I have a fantastic plan. It gives you insurance cover and great returns. It sounds tempting for sure, but is it actually a good idea? Should you ever mix these two things? Well, the answer becomes really, really simple when you think about it like this. Insurance and investment, they have two totally different jobs. Trying to make one product do both jobs is like, trying to make a cold lassi in a pressure cooker. It just doesn't work. Insurance is a shield. It's a safety net, there to protect your family from a financial disaster if you're not around. Investment, on the other hand, is like a tractor. Its only job is to work hard and grow your wealth over time. You absolutely need both, but you need them as separate, specialized tools. So here it is, the big takeaway.
If you forget everything else from our session today, just remember this one golden rule. Keep them separate. Seriously, this simple idea is the bedrock of smart financial planning. It'll save you from so many common mistakes and a lot of heartache down the road.
Okay, now that we know the rule, let's talk about the products that break this rule. Let's look at the popular money traps out there. And the first one is a big one, often sold very aggressively, the unit-linked insurance plan, or as you probably know it, a ULIP. It promises you the best of both worlds, but let's lift the hood and see what's really going on inside.
So what's the deal with ULIPs? Well, a part of the money you pay goes towards your life cover, and the rest gets invested. Sounds fine, right? But here's the catch. The charges. They're often hidden in the fine print. You've got premium allocation charges, fund management charges, mortality charges, all these different fees. It's kind of like ordering a pizza, but then you get charged extra for the box, for the slicing, for the oregano, and you end up paying for a large but getting a medium. These charges slowly eat away at your investment.
And on paper, the agent might show you potential returns of 6, 8, maybe even 10%. And you think, that's not too bad. But, and this is a huge but, that's before all those charges we just talked about are taken out. The actual money that you get in your hand after 10 or 15 years, it's often much, much lower than you expected. All right, let's move on to the second popular trap. This one is the older cousin of the ULIP. You'll find it's often sold to our parents' generation as a super safe way of forced savings. I'm talking about endowment and money-back plans. Now, the problems here are even more serious if your goal is to actually build wealth. First off, your money is locked in for a really, really long time. We're talking 15, 20 years. Second, the returns are just painfully low. And third, for the big premium you're paying every year, the actual life insurance cover you get is tiny. So it fails at both its jobs. It's a bad investment and it's bad insurance. Just look at this number, 4 to 6%. In India, inflation itself is often around 6% or even more. What does that mean? It means your money is actually losing its value over time. You think you're saving, but after 20 years, the actual purchasing power of your money could be less than when you started. It's like running as fast as you can on a treadmill. You're putting in all the effort, but you're not going anywhere. Okay, enough of the problems. We've seen the traps. Let's talk about the solution. Because the good news is, the smarter way is beautifully simple. It's way more powerful, and it puts you, not the insurance company, in complete control of your money. And here it is. The smart strategy is just 2 simple steps. Step 1, get pure protection. Hire a powerful bodyguard for your family's financial future. This is called a term insurance plan. Its only job is to provide a huge safety net at a very, very low cost. Step 2, invest for high growth. Take the money you save and put it into a real wealth-building engine. For tax saving, one of the best tools we have is an equity-linked savings scheme, or ELSS. That's it. Protection and investment, separate and powerful. So let's be super clear on what term insurance is. It's the purest, simplest form of life insurance. No jargon, no complex calculations, no hidden charges. You pay a small premium every year, say 10 or 15,000 rupees, and in return, your family gets a massive cover, like 1 crore rupees if something unfortunate happens to you. There are no returns, no maturity amount, nothing. Just pure, powerful, affordable protection. And what about ELSS? Well, an ELSS is a special type of mutual fund that's built specifically for tax saving under Section 80C. It takes your money and invests it in the stock market, which gives it the potential to grow at a much higher rate over the long term. And you know the best part? Of all the 80C options, it has the shortest lock-in period, just 3 years.
So, we've talked about the theory, but does this simple combo strategy actually perform better in the real world? Well, you know what they say. Talk is cheap. Let's put these products head to head and let the numbers do the talking.
This table just makes it all crystal clear, doesn't it? Let's just go down the list.
Purpose? The combo strategy keeps things separate and efficient. Returns? ELSS has the potential for much higher returns. Lock-in period? ELSS wins again with just 3 years. Insurance cover? A term plan gives you a massive cover for a low cost. And what about cost? Well, the combo is by far the cheapest. In every single category, the term plus ELSS combo is the clear winner.
To make this even more real, let's take a simple example. Let's meet Mr. Rahul. He's 30 years old, he's a salaried employee, and he wants to invest 1,20,000 rupees this year to save tax under the old regime. Let's see what happens to his money if he picks a ULIP versus our smart combo.
Okay, this is the moment of truth. After 20 years of investing the exact same amount of money every year, just look at that difference. With the ULIP, Mr. Rahul ends up with about 30 lakh rupees, which, is okay. But with the term plus ELSS combo, he has a whopping 70 lakh rupees. That's more than double the money. This is the real-world impact of making a simple, smart choice.
So let's just quickly summarize what happened here. For the exact same annual payment of 1.2 lakhs, Rahul gets way more protection for his family, a 1 crore life cover versus maybe just 15 lakhs with the ULIB, and he ends up with more than double the wealth. I mean, it's not even a competition. It is an absolutely clear knockout winner.
So, after all of this, what should you take away? What is the one simple action plan for your money and for your family's future?
Here's the final verdict. Just avoid mixing insurance and investments. Products like ULIPs and endowment plans are, more often than not, inefficient and costly traps designed to benefit the seller more than you. The simple, clean, and powerful combination of a pure term insurance plan for your protection and an ELSS fund for your growth is almost always the best choice for a salaried person in India.
Now, I know what some of you are thinking. This is all great, but what if I've chosen the new tax regime? I don't get any ADC deduction. That's a very important question. And the answer is, this advice still holds true. Think about it this way. Do you stop wearing a helmet just because there's no fine for it? Of course not. Protection is essential, so term insurance is a non-negotiable, tax benefit or not. And you still want your money to grow, don't you? ELSS is still a fantastic tool for creating wealth in the long run. The logic here is about smart financial planning, not just tax saving.
So we'll end with this. And this isn't just a question on a slide, this is for you to really think about. Take a look at your own policies, your own investments. Now that you know the difference, is your hard-earned money really in the right place? Is it working as hard as it should be for you? Just think about it. In our next session, we'll dive into Module 5 and explore another fantastic topic, smart salary structuring to increase your take-home pay. I'll see you there.
Hello, everyone, and welcome back to our course, Smart Tax Planning for Salaried Employees. You know that feeling, right? You work so hard, you invest your money wisely, and you see it grow, and then the tax bill comes and just takes a slice of your profits. It can be super frustrating. In our last session, we got deep into advanced deductions. Well, today, we're jumping into a really important chapter from Module 4, all about tax-free and low-tax income sources. We're going to learn exactly how to legally shield our investment profits. All right, let's get into it. I think every single one of us who invests knows this feeling all too well. You watch your portfolio go up, you're feeling good, and then you remember, oh yeah, taxes. It can really feel like you're climbing a ladder and someone keeps pulling it down a step. But you know what? It doesn't have to be that way. The secret to smart investing isn't just about what you make. It's about what you get to keep. And that, my friends, is all about smart tax planning.
So, think of today's class as us building a financial shield for your hard-earned money. We're going to start with the super safe, 100% tax-free options. Then we'll get into the more exciting world of stocks and mutual funds and uncover the smart tax strategies there. And finally, we'll tackle the big one for most Indian families, property. Let's get started.
Okay, first up,
let's talk about the absolute safest bet on the field. I'm talking to you if you're someone who thinks, look, I don't want a lot of risk, but man, I really hate paying tax on my earnings. If that sounds like you, then you're gonna love this.
So what exactly are these things? Well, think of it like this. You're basically giving a loan to huge government-run companies. Like the NHAI that builds our amazing highways, or the Indian Railway Finance Corporation. And in return for your money, the government gives you a promise, a rock-solid guarantee, that whatever interest you earn is completely 100% tax-free. It's really that simple. And because it's government-backed, it is about as safe as an investment can get.
Now this is where it gets really interesting. You look at this table and your first thought might be, hey, the bank FD is giving 7%, that's better than 6%. But hold on a second. You have to think post-tax. If you're in, say, the 30% tax bracket, the government takes its cut from that 7%. So your actual take-home is only 4.9%. Now compare that to the 6% from the tax-free bond, where you keep every single paisa. Suddenly that 6% looks a whole lot better, doesn't it?
So who should really be looking at these? Well, they are absolutely perfect for people in the higher tax brackets, like 20% or 30%. Think about a senior manager at an IT company, or maybe a small business owner who's doing well. You're already paying a good chunk of tax on your main income. This is a brilliant way to create a second, steady stream of income that the taxman can't touch. And of course, for retirees who just want a predictable, safe, and tax-free return, this is a no-brainer.
Okay, so that covers the super safe side of things. But I know what some of you are thinking. What about higher growth? What about stocks and mutual funds? You're right. The returns there can be way, way bigger. But how does the tax work? Let's dive in and break it all down.
First things first, there's been a major rule change that you absolutely have to know about. A few years ago, dividends were tax-free in our hands. Well, that's gone. Now, any dividend you get is simply added to your total income and gets taxed at your normal slab rate. Oh, and one more thing. If you get more than 5,000 rupees in dividends from a single company, they're required to cut 10% tax right away. This is what we call TDS, or tax deducted at source. Don't worry, you can adjust it when you file your returns, but it's something to be aware of.
But okay, after that not-so-great news about dividends, here comes the really good news. This right here is the golden rule for anyone investing in the stock market. Listen carefully. Every single financial year, the first 1 lakh rupees of profit you make from selling your shares or equity mutual funds, as long as you've held them for more than 1 year, is 100% tax-free. This is huge. And it gets even better. For any profit you make over that 1 lakh limit, you only pay a small, flat tax of 10%. Just 10%. Now think about that. You might be paying 20% or even 30% tax on your bank FD interest, but here, on your long-term equity gains, it's just 10%. This is exactly why so many people say that long-term investing in equities is one of the most tax-efficient ways to build wealth in India. So that brings up a question. How do you make sure you actually use this 1 lakh tax-free limit every year? Well, there's a really smart and, I must stress, completely legal strategy called tax harvesting. Here's how it works. Toward the end of the financial year, say in February or March, you look at your portfolio. You sell just enough of your investments to book a profit of, say, 90,000 or 1 lakh rupees. Boom, that profit is now tax-free for the year. And if you still love that stock or fund, no problem. You can just buy it back the very next day. What you've done is you've cleverly used your yearly tax-free allowance. It's a fantastic habit to get into. All right, let's shift gears and talk about what is, for so many Indian families, the single biggest investment they'll ever make, their home. So what happens when you decide to sell that property? You might make a big profit, but how do you save yourself from a big tax bill? Okay, so the tax law actually gives you some really powerful tools here. First, if you sell a house after holding it for at least 2 years, the profit is a long-term capital gain. The tax rate is 20%, but, and this is a big but, it's calculated after something called indexation.
Indexation is basically the government's way of saying, we know inflation happened, so we'll let you increase your original purchase price to account for it. This is great because it lowers your taxable profit. But here's the best part. You can actually make that tax zero. How? Two main ways. You can either take that profit and reinvest it into buying another house, or you can invest up to 50 lakh rupees of that profit into specific government bonds. The key takeaway? With a little bit of planning, you can save a ton of tax.
Okay, we've talked a lot of theory. But theory is one thing. Let's see how this all works in the real world. Let's take a simple example. Meet Mr. Raj.
So, have a look at Mr. Raj's income for the year. He got 50,000 rupees from his tax-free bonds. Tax on that? A big fat zero. He got 70,000 in dividends, which, as we know, will get taxed at his regular rate. But now look at the magic. He made a profit of 1,80,000 rupees from his equity mutual funds. Because the first 1 lakh is totally free, he only has to pay tax on the remaining 80,000. And that tax is just 10%. So his tax bill on that huge gain is only 8,000 rupees. Now that is what I call smart tax planning.
All right, let's bring it all home with a quick summary. Honestly, this slide is your cheat sheet. You might even want to take a screenshot of this one to keep handy. It's your simple playbook for investment tax. Tax-free bonds are a straight zero. For long-term equity, remember that magic 1 lakh rupee limit. And for property, your ticket to zero tax is reinvestment. Simple, right?
Okay, before we wrap up, a little thought experiment for you. Let's say you sold a property, and after all the calculations, your taxable profit is 20 lakh rupees. Based on what we just discussed, what could you do to make the tax on that entire 20 lakhs zero? Think about it. We just talked about the options.
And that's a wrap for today's class. We've covered a lot of ground on how to legally and smartly shield your investment income from taxes. So what's next? Well, in our next session, the final chapter in Module 4, we're going to get really personal. We'll talk about how to choose the right tax-saving investments that fit your specific goals, your age, and your risk appetite. It's going to be super practical. I really hope you found today useful. Thanks for joining me, and I'll see you in the next class.
Welcome, everyone. Today we're jumping into a really important lesson from our course, Smart Tax Planning for Salaried Employees in India. We're going to talk about something that affects every single one of us, our salary, and more importantly, how to unlock its hidden potential.
So let's start with the big question, the one we all ask ourselves every month when the salary hits our bank account. You see that big CTC number on your offer letter, right? But the actual cash you get, it feels, well, a whole lot smaller. So where on earth does all that money go?
Well, the answer lies in something called smart salary structuring. And in this lesson, which comes straight from Module 5 of our course, I'm going to show you exactly how it works. And listen, this is all about legally and intelligently increasing your take-home pay without needing a raise.
Okay, let's dive right in. What is this smart structuring I'm talking about? Don't worry, it's not some complicated trick or shady loophole. It's actually just about arranging the different parts of your salary in the smartest way possible, usually in a simple conversation with your employer.
Think of it like this. Your CTC is like a big basket of money your company has for you. Smart structuring is just you deciding how to split that money into smaller baskets. Now here's the key. Some of those smaller baskets, like specific allowances or reimbursements, are tax-free. This strategy is an absolute game changer if you're in the old tax regime because it's full of these kinds of deductions. The new regime is simpler with lower rates, sure, but you give up most of these benefits, so this kind of planning isn't quite as powerful there. Now, let's look at some simple, everyday things you're probably already spending money on that can actually save you a ton of tax. This is where it gets really interesting. First up, meal vouchers. You know those Sodexo cards or food coupons a lot of companies give out? Well, the government basically says that up to 50 rupees for your meal doesn't count as taxable income. The only rule is it has to be non-cash, like a card or coupon. It's literally tax-free money for your lunch.
And look at what that adds up to. If you calculate it for 2 meals a day across all the working days in a year, you're looking at around 26,400 rupees. That's money in your food card that you pay zero tax on. Amazing, right? And it's the exact same logic for your phone and internet bills. I mean, you use them for work, right? So if your company reimburses you for those expenses, meaning they pay you back after you show them the actual bills, that money is completely tax-free. You just have to remember to submit those receipts.
All right, let's build on that. Some company perks that might seem out of reach, like a company car, can be incredibly tax efficient for a lot of people, not just the top bosses.
Now here's the really clever bit. When your company gives you a car, you don't pay tax on the huge cost of the car or its EMI. No way. Instead, the income tax department just adds a tiny, fixed amount to your income for tax purposes. It can be as low as 1,800 rupees a month. This is almost always a much better deal than taking a fat, fully taxable travel allowance in cash.
So what this all comes down to is knowing the difference. You've got to know which perks are tax-free and which ones are taxable. The laptop your company gives you for work? Tax-free. Your PF contribution, as long as it's within the limits, also tax-free. But what about a rent-free house from the company? That one's a taxable perk. Knowing this difference is absolutely crucial.
Okay, enough theory. I know. Let's see how this all comes together in a real-world scenario. Let me introduce you to Rohan.
So Rohan here has a CTC of 12 lakh rupees a year. He's doing well, but like pretty much everyone, he wanted to see a bit more of that money in his bank account each month. So he had a simple chat with his HR. He didn't ask for more money. He just asked to, rearrange his existing CTC.
Now check this out. This is where it all clicks. In the before column, Rohan had a special allowance of 3.6 lakhs, and every single rupee of that was taxable. Now look at the after column. He cleverly converted a big chunk of that allowance into our tax-friendly friends, meal vouchers, phone reimbursement, and a car lease benefit. And look at the last line, the most important one. His taxable income, the number the government actually uses to calculate his tax, dropped by a whole lakh. So, what was the final result of all this? That one smart conversation put an extra 15,000 rupees back into Rohan's pocket every single year. That is the real power of smart structuring. He didn't earn more, he just kept more of what he already earned. And this is absolutely something you can do too. It's not as complex as it sounds, I promise. Here's a super simple 4-step action plan to get you going. First things first, just go talk to your HR department. Ask them what options are on the table. Second, if you have a choice, always prefer a tax-free benefit over the same amount in taxable cash. Third, you've got to be a little disciplined. Keep all your bills and receipts safe for those reimbursements. And finally, just be aware of the limits for each benefit so you stay well within the rules. And I want you to remember this. The whole point here is to make your salary work much harder for you. This isn't just about saving a bit of tax this year. It's about building a strong foundation for your entire financial future. It's really the first step toward building real wealth. And that's our lesson for today. Now that you know how to maximize what you take home, in our next chapter, we're going to tackle the next big question. What do you do with all this extra money you've saved? We'll dive into smart investments that can save you even more tax, especially under the famous Section 80C. I'll see you then.
Hey everyone, and welcome. Today, we're going to get into something really important, a part of your salary that can seriously help you build wealth. We're talking company shares and bonuses. Let's figure out how you can plan your tax on them the smart way.
So imagine this. Your company's offered you shares, or maybe that big performance bonus is just around the corner. That's fantastic news. But then the big question pops into your head, right? How much of that am I actually going to keep after tax? Well, that's exactly what we're going to clear up right now.
All right, welcome back to our course on smart tax planning. Last time, if you remember, we got into the nitty-gritty of salary structuring. Today, in what is now Chapter 16, we're tackling two really key parts of your pay: employee stock options, ESOPs, and of course, those annual bonuses. Let's break down exactly how the taxman looks at them. Okay, let's jump right in with the trickiest one first: ESOPs. Now, if there's one thing you need to remember about them, it's this: you can get taxed on them twice. Yep, you heard that right, twice. But don't worry, once you understand when and how, planning for it becomes a whole lot easier.
Just think of your ESOPs as having a four-step journey. First, there's the grant. That's when your company offers you the option. Simple enough. Then comes vesting. This is the waiting period before you earn the right to actually buy those shares. Now the magic happens at step 3, exercise. This is when you buy them. And boom, this is tax point number 1. The final step is the sale, when you sell them on the market. And yeah, you guessed it, that's tax point number 2.
So let's look at that first tax hit, shall we? The very moment you exercise or buy the shares, the income tax department sees it as a benefit. They have a fancy word for it, a perquisite. Now, how do they calculate it? Well, they just take the share's market value on that day, the FMV, and subtract the price you paid for it. That difference, that paper profit, is added to your salary for the year and taxed at your slab rate.
And now for tax hit number 2. This one happens when you finally sell your shares. Here, the tax is on your actual profit, and that's calculated as your selling price minus the market value on the day you first bought them. This profit is treated as a capital gain, just like the profit you'd make from any other stock market investment.
Okay, I know that's a lot of theory. To make this all crystal clear, let's walk through a real-world example. Everyone meet Mr. Arjun. We're going to see how this ESOP taxation works out with some actual numbers.
So, Mr. Arjun decides to exercise his option to buy 1,000 shares. He gets to buy them for 200 rupees a share, but on that day, the fair market value, or FMV, is 350. You see that 150 rupee difference? That's the benefit. So for 1,000 shares, that comes to 1,50,000 rupees, which gets added to his salary and taxed. That's tax point 1. Done.
Okay, fast forward 15 months. Mr. Arjun decides to sell his shares, and the price has gone up to 420 rupees each. Nice! His capital gain is the profit he made since he bought them. So that's the sale price of 420 minus the market value of 350 when he exercised. For 1,000 shares, this gives him a total gain of 70,000 rupees.
And you know what? Here is where smart planning really pays off. Because Mr. Arjun held his shares for more than 12 months, that 70,000 rupee profit is a long-term capital gain. And in India, the first 1 lakh of long-term gains from stocks is completely tax-free every year. So what's his tax bill on this sale? A big, beautiful 0. See how powerful that is?
Phew! Okay, that covers ESOPs. Now, let's talk about their much simpler cousins, restricted stock units, or RSUs, and of course, the annual bonus. You'll see these are way more straightforward. With RSUs, it's different. There's no option to buy. The company just gives you the shares directly when they vest. So the tax is simpler, too. The entire market value of those shares on the day you receive them is added to your income and taxed as salary. That's it. Just one tax event until you decide to sell them later on.
And what about that performance bonus? Well, there's no special trick here, I'm afraid. It's the simplest of all. The entire bonus amount, whatever it is, gets added straight to your salary in the year you receive it and is fully taxable. No special exemptions, no deductions against it. Simple as that.
This little table here makes the difference super clear. Just look at that first tax event. For ESOPs, it's only the benefit part that's taxed as salary. But for RSUs and bonuses, the entire value is taxed as salary right up front. That is the key distinction you have to remember for your planning.
All right, now that we know how it all works, let's get to the best part.
how do we plan and save some tax? Here are a few simple, practical tips you can use.
First off, timing is everything. Try not to exercise your options in the same year you're getting a huge bonus. Why? Because that could push you into a higher tax bracket. Second, think about liquidity. If your company isn't listed on the stock market, how easily can you sell a few shares to pay that tax bill? And finally, the golden rule. If you can, always aim to hold for more than 12 months. That long-term capital gains benefit is too good to miss.
Now for bonuses, timing is your best friend here too. Have a chat with your HR. See if a really big bonus can be split across 2 financial years, maybe some in March and the rest in April. This little trick could keep you from jumping into a higher tax slab. Also, if you're still using the old tax regime, a bonus is the perfect chance to max out your Section 80C investments like PPF or an ELSS fund.
Okay, we've covered a lot of ground. So, after all that, what are the absolute most crucial points you need to walk away with?
Let's just quickly recap. Number 1, ESOPs have that 2-step tax process. Salary first, capital gains later. Number 2, RSUs are simpler, but remember, the whole value hits your salary income all at once. And number 3, for your bonus, it's fully taxable as salary, which makes timing your most important planning tool.
Fantastic job today. You now have a solid framework to plan around your company stocks and your bonus. The real key is to be proactive, not reactive. Just thinking about these things ahead of time is half the battle won. Now, next time, we're going to tackle the biggest question in Indian income tax today. Old regime versus new regime. Which one is right for you? We're going to do a deep dive. I'll see you in the next class.
Hey everyone, and welcome. If you're trying to figure out how to save the most tax this year, well, you are in exactly the right place. Let's get straight into it.
Ah, yes, it's that time of year again, isn't it? Your HR is sending emails, your friends are all debating, and you're probably looking at your salary slip thinking, which one do I choose? It is the big question for every single salaried person in India.
All right, class is in session. We're actually pulling today's lesson straight from Module 6 of our course, Smart Tax Planning for Salaried Employees, to tackle this exact question. So think of this as your own personal masterclass. We're going to break down the rules, run some real-life numbers, and trust me, by the end of this, you'll know exactly what to do. So what is the fundamental difference here? What's the big deal? Well, at its heart, it's a pretty simple choice. It's like choosing between getting a straight-up discount on your final bill or using a whole bunch of special coupon codes to get the price down. This slide really lays it all out. Think of the old regime as a big a la carte menu. Yeah, the prices or the tax rates look a little higher, but you get to use all these fantastic coupons. You know, your deductions like HRA, ADC, and home loan interest to slash the final bill. Now, the new regime, which, by the way, is the default option now, is more like a simple combo meal. The price is already lower, but you can't use most of those coupons. It all boils down to this: lower rates versus the power of deductions. Okay, first up, let's look at the new regime's tax slabs. As you can see, the rates look pretty good. They're lower and they're spread out more gently. But the real magic here isn't just on this table, it's the rebate. Because of a combination of the standard deduction and a tax rebate, if your income is up to 7.5 lakh rupees, you pay 0 tax. Nothing. This is what makes the new regime a real game changer for so many people. Now, let's switch over to the old regime. I know. At first glance, these rates look much scarier. Look at that jump, from 5% straight to 20%. And anything over 10 lakhs goes right into the 30% bracket. It looks like a bad deal, but don't be fooled. Its secret weapon is the deductions.
And here they are. These are the powerful tools you get to use in the old regime. We're talking about your PF contribution, your kids' school tuition fees, your life insurance premium. That's all under Section 80C. Or the huge interest component of your home loan EMI. Even the rent you pay for your house. Every single one of these can chop down your taxable income in a big way. And remember, in the new regime, you have to say goodbye to most of them.
All right, enough theory. It's time to see how this all plays out in the real world. We're going to take two very common examples and see which regime wins in different situations.
So first, let's meet Priya. She's a young professional earning a solid 10 lakh rupees a year. She's just getting started in her career, so she doesn't have a home loan yet and not a lot of tax-saving investments. I think this is a pretty relatable profile for many of us, right?
Okay, let's crunch the numbers for Priya. Under the old regime, even after her standard deduction, she's looking at a tax bill of over 1 lakh rupees. Ouch. But just look at the new regime column. Can you believe it? Even at a 10 lakh salary, her final tax is 0. A big fat nil. That is a huge difference.
So, what's the verdict here? For Priya, and honestly for a lot of people earning up to 12 lakhs with minimal deductions, the new regime is an absolute no-brainer. It's just simpler, and it puts more money directly into her bank account. No fuss.
Okay, let's move on to our second case. Now meet Ravi. He earns a bit more, at 16 lakh rupees, and he's got a few more financial responsibilities. He's paying a home loan EMI, he's got health insurance for his parents, and he's a regular investor. Now, look at all the deductions Ravi has in his toolkit. He maxes out his Section 80C with his PF and other investments. He's got a big home loan interest payment, plus medical insurance and HRA. You can see these are pretty substantial amounts, and they're going to make a massive difference in his tax calculation.
And here is where you see the real power of the old regime shine. Look at this. Ravi's deductions bring his taxable income all the way down from 16 lakhs to 10 lakhs. His final tax bill is about 1.12 lakhs. But under the new regime, without those powerful deductions, his tax would be way higher, around 1.41 lakhs. So the verdict is crystal clear. For Ravi, sticking with the old regime and using all those deductions is absolutely the smarter financial move. It just goes to show there is no single best option. It's truly personal and depends on your life situation.
So the big question is, how do you figure out if you're a Priya or a Ravi? Well, don't you worry, we've put together a simple little cheat sheet to help you find your profile.
Let's just walk through this table. It should make your choice a lot clearer. Find the profile that sounds most like you. If your salary is up to 12 lakhs, chances are the new regime is your best friend. Got a high salary but don't really have many investments or a home loan, the new regime's simplicity and lower rates will probably still win. But, and this is a big but, if you have a home loan, you pay a lot of rent, and you max out your ADC, then the old regime is almost definitely your champion.
Whew, we've covered a lot of ground. So before we wrap up today's lesson, let's go over a final actionable checklist. This will make sure you are all set for the financial year.
Here is your super simple 3-step plan. Step 1, always calculate. Please don't guess. Just use any online tax calculator, plug in your numbers for both regimes, and see the result for yourself. Step 2, inform your employer. This is important so they deduct the right amount of TDS from your salary every month. And step 3, and this is the most crucial part, don't stress about it. You can actually switch your choice when you file your final income tax return. You are not locked in for the year.
And that's a wrap on our deep dive into the old versus new tax regimes. I really hope you're feeling a lot more confident about your choice now. In our next class from the course, we're going to tackle another super important chapter, avoiding common mistakes and tax notices. You are definitely not going to want to miss that one.
But before you go, I want to leave you with a little bit of homework. Let's apply what we've learned today, right? If your salary is 18 lakhs and you have total deductions of 4 lakhs from your home loan, ATC, the whole lot, which regime should you choose? Go on, run the numbers. The answer might just save you thousands of rupees. Thanks for joining the class today, and I'll see you next time.
Hey everyone, welcome back. So in our last session, we really got into the details of the old versus the new tax regime, right? Well, today we're jumping into something super practical from Module 6 of our course, making sense of all those tax documents. You know, getting this part right is pretty much the secret to a stress-free tax filing season. So, let's get started.
So, our goal for today is to break down all the documents you'll need when you sit down to file your income tax return. And look, I really want you to stop thinking of it as this big, scary task. It's not. It's actually more like solving a simple puzzle. All the pieces are already in front of you. You just need to learn where each one fits.
Let's be real for a second. Haven't we all had that little voice in the back of our heads going, what if I mess something up and get a notice from the tax department? It's a common fear. But here's the good news. Avoiding that notice is way, way simpler than you might think. You really don't have to be some kind of tax guru. You just need to get a handle on the pieces of your own financial puzzle.
And you know what? The entire solution, the key to filing your taxes accurately and, with total confidence, it all boils down to just 4 key documents. Seriously, that's it. Once you figure out what they are and how they talk to each other, the whole thing just clicks into place. Okay, so let's introduce the main players in our little puzzle. These are our 4 clues. We've got Form 16, Form 26AS, the Annual Information Statement, which everyone just calls AIS, and the Taxpayer Information Summary, or TIS. Let's break down exactly what each one of these does.
All right, first up, Form 16. Now, every single year, your employer has to give you this. It doesn't matter if you work for a giant like TCS or a small startup, it's the law. The easiest way to think about it, it's your annual salary report card. It basically lists out your total salary for the year and, crucially, confirms how much tax, or TDS, your company has already cut and paid to the government on your behalf.
So if you look at your Form 16, you'll see it split into 2 parts, Part A and Part B. Part A is really simple. It's just the official proof that the tax your boss deducted has actually reached the government's account. Part B is where all the juicy details are. It's got your complete salary breakup, all the deductions you declared to your company, like for your PPF under 80C or that health insurance for your parents under 80D, and then it shows the final calculation of your taxable income.
Okay, next up is Form 26AS. Now, I want you to think of this one as your personal tax passbook, but instead of a bank, this passbook is maintained by the Income Tax Department itself. Literally any tax that's been paid against your PAN card, it doesn't matter who paid it, it gets logged right here.
And this is so important because Form 26AS sees more than just your salary. For instance, you know that fixed deposit you have. If the bank deducted any TDS on the interest, boom, it shows up here. If you paid some advance tax on your own, yep, that's here too. This form is basically the ultimate proof that every rupee of tax deducted for you has safely reached the government.
All right, now we get to a relatively new player in the game, but oh boy, is it important. It's the AIS, or Annual Information Statement. Honestly, the best way I can describe it is like the government CCTV footage of your entire financial year. The tax department gathers information from all over the place, banks, mutual fund houses, property registrars, and compiles it all in this one statement.
I mean, just look at the kind of information it's tracking. It's got your salary, obviously, but it also has that tiny bit of interest you earn from your savings account. The dividends you got from, say, your Infosys shares, it's in there. Details of the mutual funds you sold, yep. It even knows if you bought a new flat. It gives the tax department such a complete picture that it becomes almost impossible to accidentally forget to report some income. And our last clue is the TIS, or Taxpayer Information Summary. This one's super straightforward. Think of it as the executive summary of your AIS. It takes all that detailed information from the AIS and just gives you a neat one-page summary. It's absolutely perfect for a quick glance to see the grand total of income the tax department thinks you have right before you start filing.
Okay, so we've met our 4 clues. Now comes the fun part, the investigation.
how do we actually use these documents together to make sure every number lines up perfectly? Well, it's really just a simple process of cross-checking.
Here's your simple 4-step checklist. It's that easy. First, you start with your Form 16. That's your base. Second, you cross-check the tax amount from Form 16 with your Form 26AS to make sure they match up. They have to. Third, you scan through your AIS to catch any other income sources, like that FD interest or dividend we talked about. And finally, just use the TIS for a quick final check of the total income number. See? Super straightforward.
So, the big question: what happens if the numbers don't match? First thing, don't panic. Mismatches are actually pretty common. And the good news is they're usually quite easy to fix. To really get how this works, let's look at a classic case.
So, let's talk about Miss Neha. Like so many of us, she figured that filing her taxes was simple. Just copy-paste the numbers from her Form 16 into the tax portal. It's probably one of the most common mistakes people make, and honestly, it almost landed her in a bit of hot water.
Luckily, before she filed, she decided to check her AIS, and she got a bit of a shock. It was showing an extra 70,000 rupees of income that was nowhere to be found on her Form 16. And where did it come from? Well, 20,000 rupees was from dividends on her shares, and another 50,000 was interest from a fixed deposit she had. Her Form 16 didn't show this, of course, because it only knows about her salary. And this right here is exactly why we do this reconciliation. Think about it. If Neha had gone ahead and filed her return declaring only her salary of, say, 12 lakh rupees, the tax department's computers would have immediately flagged it. Why? Because their records, the AIS, showed her total income was actually 12.7 lakh rupee. That mismatch is a huge red flag and would have almost guaranteed a tax notice.
So what's the fix when you find a mismatch? Well, if the TDS from your Form 16 isn't showing up in your Form 26AS, you need to have a word with your HR or accounts team. They need to fix it from their end. But for something like extra income showing up in your AIS, like that FD interest, the fix is on you. It's simple. You just have to add that income to your total income when you file your return. At the end of the day, remember, it's your responsibility to declare everything.
See, when you follow this little process of checking and matching, something amazing happens. You go from feeling uncertain or worried to being completely confident. You're not just blindly filing your taxes anymore, you are actively verifying and confirming that what you're submitting is a true and complete picture of your financial year.
So, to wrap this all up, let's quickly go over the golden rules. Rule number 1. Before you even start filing, download your Form 26AS, your AIS, and your TIS. Always. Rule number 2. Never, ever rely only on your Form 16. It's just one piece of the puzzle. Rule 3. Report all of your income, even if some tax has already been cut on it. And finally, Rule 4. It's just smart practice to keep your salary slips and bank statements handy, just in case you need them as proof. Okay, so now you know exactly how to read and reconcile all your key tax documents. This sets us up perfectly for our next session, and in that one, we're going to roll up our sleeves and go through the actual step-by-step process of filling out and submitting your income tax return online.
So, after today, you literally have all the clues in your hand. You know what each document is for, and you know exactly how to piece them all together. That big, scary tax puzzle, it doesn't seem so intimidating anymore, does it? You're absolutely ready to solve it.
Let's be real for a second. Does the thought of filing your income tax return give you a little bit of stress? Yeah, you're definitely not alone. But in this part of our course, we're going to change that. We'll break down the entire process and make it genuinely simple.
Welcome back. Today, we are diving into a really important part of our course, Chapter 19, Filing Your Income Tax Return. So far, we've talked all about deductions and exemptions. Well, this is where we put all that learning into action. We're going to turn that tax time anxiety into pure confidence.
You know that feeling, right? You see a notification that says tax deadline and your stomach just drops a little. It really doesn't have to be that way. My goal today is to give you a clear step-by-step plan so you can file your return feeling totally in control.
So where do we even start? Well, the very first step, the first decision you have to make is choosing the right form. Are you an ITR 1 person or an ITR 2 person? Let's figure it out. Okay, this choice is actually way simpler than it sounds. On the left, you've got ITR 1, which is also called Sahaj, and that literally means easy in Hindi. This form is for most of us salaried folks whose total income is under 50 lakh rupees, and it comes from pretty straightforward sources. Salary, one house, maybe some bank interest. Now, ITR 2 on the right is for slightly more complex situations. Maybe your income is over 50 lakhs, or, and this is a big one, if you have any capital gains from selling things like shares or mutual funds.
Let's make this crystal clear with a couple of quick examples. So, meet Ria. She has a salary of 9 lakhs, owns one house, and has a little bit of interest from her savings account. Her situation is simple and clean. She files ITR 1. Now over here is Arjun. He earns more, has 2 house properties, and he made some capital gains from his mutual fund investments. His finances have a few more moving parts, so he absolutely has to file ITR 2. See? The main thing to remember is that your sources of income decide which form you use.
All right, you've picked your form. High five. So what's next? Let's get into the actual filing process. I've broken it down into a simple, totally manageable guide.
The entire filing journey, believe it or not, boils down to just 3 main stages. Stage 1 is all about getting ready. This is where you gather your documents, and the hero document here is your Form 16 from your employer. Stage 2 is where you fill and review. You log into the tax portal, you check the data that's already pre-filled for you, and you add in all those deductions you've been planning. And finally, stage 3 is submit and verify. You pay any tax that's due, you hit submit, and this is crucial, you verify your return. The easiest way is with a quick Aadhaar OTP.
Now you're going to hear these terms thrown around a lot. Form 26AS, AIS, and TIS. Don't let the jargon scare you. Just think of these as your tax passbooks issued by the government. They show every single bit of income that's been reported against your PAN card and all the tax that's already been paid for you. It's your job to look at these and make sure they match your own records.
And I really can't say this enough. Hitting that submit button is not the final step. I repeat, it is not the final step. Your return is considered invalid. It's like you never even filed it until you verify it. The quickest way for most people is with that Aadhaar OTP. It literally takes a minute, so please, please, please don't forget this vital step.
Okay, so now you know the process, you know what to do. Let's switch gears and talk about what not to do. So many people get tax notices because of small, completely avoidable mistakes. Let's make sure you're not one of them. Here are the top 4 traps you need to sidestep. First, picking the wrong ITR form, like using the simple ITR 1 when you actually have capital gains. Second, and this is a big one, forgetting to declare all your income, like that interest you earned from a fixed deposit. Third, trying to claim deductions like ADC if you've opted for the new tax regime. Remember, the new regime gives you lower tax rates, but you give up most deductions in return. And fourth, as we just talked about, failing to verify your return. Let's dig a little deeper into that interest income point, because it's a really common mistake. Your bank reports every single rupee of interest it pays you directly to the tax department. All of it shows up automatically in your AIS. So if you forget to declare it in your return, the system immediately sees a mismatch. A red flag goes up, and that could easily trigger a tax notice. And just like that, look at you. You've gone from feeling maybe a little bit of tax anxiety to having real tax confidence. You now have all the fundamental knowledge you need to handle your ITR filing smoothly. So let's just quickly recap what you've achieved today. You now know how to correctly pick the right ITR form for your exact financial situation. You've got a simple 3-stage roadmap to make filing a stress-free process. And most importantly,
You know exactly which common mistakes to watch out for, so you can file with confidence and keep those tax notices away.
I hope you're feeling pretty empowered right now. And to build on that, in our very next chapter, we're going to dive into something really powerful: smart salary structuring. We'll explore how you can work with your employer to legally increase your in-hand salary. Trust me, you won't want to miss that one.
Before we wrap up, I'll leave you with a quick question. Out of everything we've covered today, from choosing your form all the way to that final verification, what is the one step you feel most confident about right now? Think about it and hold on to that feeling. That's what this is all about. Thanks for joining me, and I'll see you in the next one.
Hello and welcome back. We are here at the final and honestly the most crucial chapter of our course, Smart Tax Planning for Salaried Employees in India. We've learned all about salary structures, deductions, and investments. Now, let's nail the final step, filing your return correctly and making sure you steer clear of any of those dreaded tax notices. So think of this as our last class together. You've done all the heavy lifting, you've planned your taxes, you've saved your money all year long. This is it. Let's make sure we cross that finish line perfectly and get your tax return filed with absolutely zero stress. Ready? Let's dive in.
You know that feeling, right? That little heart-stopping moment when you see an email from the income tax department land in your inbox? But what if I told you that most of the time, like almost all the time, those notices are just because of some really simple, totally avoidable mistakes?
That's right. It's usually not some big, complicated issue. It's the small stuff, the little oversights that end up causing the biggest headaches. So let's walk through the most common errors people make just so you know exactly what to avoid.
You know what's funny about these is how easy they are to make. I mean, who really thinks about that 5,000 rupees of interest from a savings account? It just shows up, right? But to the tax department, it's income. Same goes for dividends or the profit you made selling some mutual fund units. And that last one? Oh, that's a big one. Forgetting to verify your return is like writing an exam but not handing in your answer sheet. In the eyes of the law, you just haven't filed at all.
And here's another classic trap we've talked about before. Remember back in Module 1 and then again just recently in Module 6, we did a deep dive on the old versus the new regime? To jog your memory, the old regime is the one where you get to claim all those popular deductions, your ADC, ADD, HRA, all of that. The new regime gives you lower tax rates, but you have to give up almost all of those deductions.
So you can see where this is going. If you've opted for the new tax regime to get those lower rates, you absolutely cannot claim deductions. Trying to claim your PPF investment under ATC while you're in the new regime, that's an instant red flag. The system is built to catch that. It's a guaranteed notice, no two ways about it.
Okay, so what else are the tax department's computers programmed to look out for? Let's call them red flags. These are certain financial activities that just automatically get highlighted and tell the system to take a closer look.
First up, big cash deposits. If you, over the course of a financial year, deposit more than 10 lakh rupees in cash into your savings account, your bank has to report it. Now, if the income you've declared doesn't really line up with that kind of cash moving around, it's definitely going to raise a question.
And surprise, surprise, that very same 10 lakh rupee number applies somewhere else too. Your credit card bills. If the total amount you pay towards your credit card bills in 1 year crosses that 10 lakh mark, that also gets reported. And again, the system just tries to ask a simple question: does this level of spending match the income being reported?
And really, this all comes down to one main idea: mismatches. Your AIS, or Annual Information Statement, is basically the government's file on you. It's their record of all your financial transactions. If the story you tell in your tax return is wildly different from the story that's in your AIS, well, that's the biggest red flag you can have. Same goes for things like claiming HRA when you don't even pay rent, or if you're trading shares every day but calling it a long-term investment.
All right, let's do a deep dive on one very specific rule that catches so many people out,
especially if you live in a big city like Mumbai, Bangalore, or Delhi. If your monthly rent is over 50,000 rupees, there is a special rule you absolutely have to know about.
This falls under Section 194 IB. And what it says is pretty simple. If you're a salaried person and you pay more than 50,000 rupees a month in rent, then you are responsible for deducting tax at source, or TDS. And the rate is 5% on the total rent for the year.
Now, I know it sounds complicated, but the process is actually pretty straightforward. First, you just calculate what 5% of your entire year's rent is. Now, you don't deduct a little bit every month, no. Instead, you deduct that entire TDS amount from the rent you pay for the very last month of the financial year, which is usually March. Then you just pay that tax to the government and give your landlord a certificate.
Let's look at an example. Say Miss Neha pays a rent of 55,000 rupees a month. Her total rent for the year is 6,60,000 rupees. Okay, so 5% of that is 33,000 rupees. So when March comes around, she won't pay her landlord the full 55,000. She'll only pay 22,000. That's the rent minus the TDS. And the other 33,000? She'll deposit that with the government on behalf of her landlord.
So what happens if you just forget to do this? Well, you go ahead and claim your HRA for a rent of 6.6 lakhs. Your landlord also reports a rental income of 6.6 lakhs, but the system sees that the required TDS was never deducted. That creates a mismatch, it's flagged automatically, and boom, a notice gets sent out.
Okay, enough about the problems. We've seen all the ways things can go wrong. Now, let's talk about the solution. How do you make sure your filing experience is smooth and stress-free every single time? It all comes down to a simple checklist.
So, before you even think about logging into the tax portal, get all your paperwork together, your Form 16, bank statements, all of it. But the most important thing, your secret weapon, is to download and carefully read your Form 26AS and your AIS. Think of these as the government's report card on your finances. Your job is just to make sure your answers match theirs. Now, when you're in the middle of filing, just be careful. The key here is to reconcile everything. Does your Form 16 salary match what's in your AIS? Did you report every single rupee of interest income? And please, I beg you, right before you start claiming deductions, just do one final check. Are you in the old or the new regime this year? And listen, you are not done when you hit that submit button. This is probably the #1 mistake people make after filing. You must e-verify your return, usually with your Aadhaar OTP, and you only have 30 days to do it now. If you don't verify, your return is simply invalid. It's like it never happened. And of course, keep all your documents saved somewhere safe for at least 6 years. So, to wrap everything up, not just for this chapter, but for our entire course, let's boil it all down into a few simple golden rules. If you can remember these, you can file your taxes with complete and total peace of mind. Rule #1, always reconcile. Your Form 16, your 26AS, your AIS, they need to tell the exact same story. Rule 2, be honest and report all your income. Full disclosure is your best friend here. 3, if you're paying that high rent, don't forget the TDS rule we just talked about. And finally, Rule 4, just be disciplined. File on time and verify on time. No last-minute panic. When you follow these steps, tax filing stops being this scary, stressful thing, and it just becomes a simple task on your to-do list. It puts you back in the driver's seat. So my final question to you as we close out this course is this. With everything you've learned, are you ready to file this year with 100% confidence?